Analysts saying that this outcome for Samsung is likely to be the bottom, so that also might play into the way that European markets respond to it. Apparel stocks in focus. If there are businesses in Europe that make a lot of product over in Asia, then could there be some read across into their ability to supply into the United States from those Asian production facilities? That's going to be a focus. And Daimler certainly in focus as well. Daimler Trucks announcing a buyback ahead of their capital markets day then, Chrissy.
It's fascinating, Anna. We are, of course, counting down to the open, and it is a little bit of a muted story when you look at the futures picture. This is the opening trade across those European markets. Right out of the gates, the FTSE 100, anticlimactic open, I think, flat, basically, when it comes to what we're going to see. But do we see a little bit more shakeout when it comes to the DAX, for example? Going back to what that lazy trade is, this is a point that Val made on the future story. Do we start to see a little bit of outperformance there? Because that's what the markets do. When we don't have direction, you buy into the DAX, you stay flat on the FTSE 100. That's going to be something that we shake out, or see something that's going to be something that we see shake out. There we go. In the next couple of kind of moments. The IBEX, though, outperforming this morning, higher by about 0.3%. The CAC Iran higher as well. That is an interesting story, given the fact that there is a read-through when it comes to the tariffs imposed on the likes of Thailand, Cambodia, even China, Japan, South Korea. There should be a read-through, and yet we are not seeing that. Val, walk us through some of those early movers as we open these markets.
Well, if you take a look at the sectors at the top, we do have basic resources. I think that's all down to that Glencore upgrade from the street. The Glencore stock rising around 1.4%. So it is showing up in the best performing sector this morning. To the downside, we do have some consumer products down there. We are seeing Pandora move to the downside. That was something that we had our eye on earlier, down around 1%. But we're basically, it looks like 50-50 when it comes to the sectors. We got 9 in the green, 10 in the red so far this morning.
Yeah, I mean, we're getting optimistic soundings, aren't we, from Europe about what they're going to be able to achieve. And the last 24 hours have been dominated by, yes, news on tariffs, but also a shifting goalpost in terms of the day that this gets implemented. So I suppose all of that leaves us a little range bound, doesn't it, Valerie? So we are, yeah, as you say, 50-50. You mentioned basic resources. I'll mention travel and leisure. That's another sector that's not doing too badly. And there's a couple of different dynamics happening there. On the one hand, you've got oil prices coming down. And so that leaves space for the likes of TUI and IAG, Lufthansa, Ryanair to make small gains, really small actually, but still there is that direction of travel. And Entain, I'll just flag this one. This is a gaming business here in the UK, and that is up by nearly 4%. They've had an upgrade from one of the banks, so that's having an impact there. To the downside, Credit, we've got real estate, personal consumer, discretionary, and grocery stores.
Well, I bet a good chunk of that downside move was coming from Diageo. I'm just looking at some of those individual movers. Unilever as well. These are two major kind of consumer goods. Even Nestle, which is kind of a defensive bid as well. But immediately what caught my eye is the Diageo story. We know they're very exposed to the tariff threats. That, of course, specifically more to Latin America, which we haven't actually seen in the last 24 hours. But if we're talking about some sort of sentiment read-through, maybe that is one. We are, of course, to your point, Anna, you mentioned Glencore and Rio Tinto. In terms of commodity space, that's where we're seeing the bid. Is that the new kind of popular trade here, that you just kind of look at the macro assets and magnify that in the absence of any real moves? We were also looking for chip sectors as well. Not much of a read-through.
Yeah, we do have the technology sector as a whole in the green so far to start this trade. We do have, some red when it comes to those chip stocks, but they're down just marginally. ASML down 0.4%, ST Micro down 0.4%. So it does seem to be a limited read-through from those Samsung earnings that came in weak in the Asia session. Anna?
Yeah, I'll mention a few of the retailers because there could be some downside there if you're manufacturing, as we said, over in Asia and then trying to send that product to the United States. There are a limited number of European retailers that have the scale to be doing that kind of trade, particularly. But there is a little bit of downside coming through on that sector. But yeah, no enormous moves. And US futures are actually pretty flat this morning as well.
I'm still surprised at the resilience of European equities. I mean, they closed at the highs yesterday, and they're adding to that today. They really seem resilient in the face of all these tariff headlines. I guess the market is really reflecting a more positive narrative about an EU-US trade deal. 10% sounds like a good number. The market's taking it as a good number.
Is it resilient, or is it the lazy trade? We keep asking our guests about that. What is the default? What is the go-to? The default for such a long time was when it's quiet, when there's less volume, light liquidity, everyone's taking their vacations this summer, you just get into NASDAQ futures and you call it a day. It feels like that new lazy trade, the complacent trade, is you buy into DAX and we call it a day.
Well, look, it's becoming a bit more clear. The EU isn't going to receive a letter with a 50% number on it or anything, higher than what was announced on April 2nd. So I think that reprieve we're seeing in the markets right now, you're seeing in the FX market, you're seeing in the equity market.
And Europe has a little bit more time to talk then. On Friday we were suggesting this August 1st date that's becoming increasingly used by the Trump administration. Maybe that'll leave more space for conversation, and then we hear confirmation from President Trump that he is open to talking over the next 3 weeks as we get towards August. And he has moved that tariff deadline for everybody, not just those countries that received letters. And maybe I should have made more of that at the top of the hour, because I think that is an interesting dynamic that we're following. So 4 minutes past 8, 4 minutes into our trading day here in Europe. European equity markets then pretty flat overall, pretty unmoved as a general rule. But let's have a look at the core 6 then and see where that takes us. We've touched on some of these names, I think, already a little bit. Novo Nordisk not moving anywhere. No big moves here. The biggest move coming from ASML. We were talking about some of that downside risk for technology, but maybe the read across is limited into that particular company. But that stock is down by 0.2%. Let's get a check on some of the individual stocks that are on the move. Joe Easton has a deeper dive for us. Joe.
A lot of these companies that are making goods over in Southeast Asia, so particularly Pandora. Remember, 95% of their jewellery made in Thailand, and we've seen that news over the weekend, or excuse me, over last night, we are still on Tuesday, that there is a tariff coming through on Thailand, 36%, that massive rate. So that is going to be a big weight on that company. And also Doc Martens, which is one that Anna flagged earlier. Now they make a lot of their products in Laos, I believe that is the country that was flagged, and therefore that one down 4.5% almost at the moment. A little bit of weakness in Puma and Adidas. We saw some weakness in Lululemon last night in the US for a similar reason. Also Nike was a little bit soft. So anyone that's making products in Southeast Asia waking up to news of these big tariffs on those countries, and therefore a lot of red on that screen at the moment. One stock though was a little bit higher, was Daimler Truck over in Germany. A bit of a share buyback on that one. It was called a few percentage points high, but potentially a lot of the more negative themes of the market weighing on that one. So we're down or up 0.6%, trimming that gain from earlier, but doing a share buyback. Daimler Truck very slightly positive today. Then moving on to energy, a couple of stories out there. Equinor, that one was a little bit weak, slightly lower output on the latest quarter for the Norwegian company. So that is very slightly lower, down 0.3% at the moment over in Oslo. But the other one I had my eye on was Galp. Now this one over in Portugal, a bit of a renewable focus on that one as well. We'll see where that one is. Up 1.4%, a little bit better on that one. So Equinor going down, Galp going up in the energy stocks today. Then moving on to my favourite part of the morning, the rating changes. We've got Entain, another one of my favourite subjects, gambling. This one is upgraded today at Bank of America. It's not the area that I like to have a flutter in football. It is all the American sports. BetMGM continues to do well according to Bank of America, and that's why they're moving the stock to buy today. I think Entain is a good one to be putting your money into, and that was actually at the top of the stock 600 at the open of trading. It's come down very slightly, but Entain gaining. Bank of America recommends buying. And then finally, just checking in on Glencore. We did flag that one earlier, and as we've already noted, it is a little bit higher. JP Morgan touting this one, going overweight. They think the company could finally spin off this big coal business. It's worth around $9 billion, and that could be positive according to JPM. So they go overweight on Glencore. Glencore rising 1.6% in London this morning.
All right, Joe Easton from our equities team walking us through some of those early movers. We thank you so much. Coming up, we're going to connect a little bit of the dots and perhaps what this stock market is responding to and how it shows up in the commodity space. Donald Trump, of course, firing off a new wave of tariff threats. We're going to dive into that ripple effect. Francisco Blanche from Bank of America is going to be joining the program. Stick with us. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Welcome back to the opening trade. Around 11 minutes into today's session, as we're seeing things shake out on the index level, there isn't much to look at, but seeing some bigger moves underneath the hood. How much of this, though, is really a question of the volatility, of caution, of complacency, or simply maybe a summer Tuesday? Joining us now for a look at the markets is Benedict Lowe, an equity derivative strategist for Europe at BNP Paribas Markets 360. Make sense of this market for us, Benedict. I mean, how do you think about these markets when they're literally not moving while the tariff rate is?
Yeah, so first of all, it looks like the scenario for Europe is playing out quite positively. We haven't received the letter yet, and the discussions are still ongoing, and they're hoping to get a deal by Wednesday, which would be the best case for Europe. Now, when we look at what was priced into the market ahead of that, the market was basically expecting a move of slightly above 1% for the 5-year. That is very low, but the reality is that positioning is a lot more lower in Europe than it was before the Liberation Day. And also there is this sense of fatigue overall, and we're seeing that throughout market overall in terms of headline news around tariff, with the market kind of pricing some negotiation down the way. So overall, we did not expect the same gamma move that we saw in April to happen this week.
Do you think, though, that we are going to see, elevated volatility levels around August 1st? Do you think that'll be the date that the market focuses on for this volatility to come?
Yeah, so we've got another extended deadline. It looks like it's going to be start of April. Before start of April, we've got a big CPI print that will be really focused in the US next week. So we've got a heavy calendar that will make it more important for the vol to play. But what I will mention is that the starting vol levels are not low in Europe. When you look at the 5-year 1-month vol, it's trading close to 16. So it's already somewhere priced in, not really at extended level, but there is a risk premium at the moment in European markets.
There's a risk premium. Okay, so we could get some volatility before August, before we get that new deadline. Now, we've got earnings season between now and then. You mentioned the US CPI print, but also earnings season. You say in your notes, Benedict, that this is supposed to be a good earnings season. Where is that positive sentiment coming from? What's driving that positive outlook?
Well, there's a few things. First of all, I think the impact from tariff is less than what was feared at the previous earnings season. When we look at what happened at the previous earnings season, we were really in the midst of uncertainty. We didn't know what the tariff rate were going to be. We had some better level with some lower levels since then, so that is a positive. Now, the key thing for Europe, where there's a lot of uncertainty, is around the impact of FX. We've had a huge appreciation of the euro currency over the past quarter. That should be positive for U.S. earnings, especially for the tech, which have a lot of revenue that is coming from non-dollar assets, but the headwind could come from Europe from a higher currency level.
What is the risk? Talk to us about that kind of swing back, because the consensus trade right now is you short dollars, you short dollars and you go long on the euro or arguably the pound even, or pick your currency. If that swings back, if you see a complete reallocation when it comes to the dollar and suddenly everyone is repositioning to, say, long dollar, for example, what kind of risk is there for European companies?
So that overall should be positive and should be a tailwind for European companies. We think there's been two main reasons why Europe has underperformed the US recently. The first one being some fears around the tariff deadline that we have this week. We saw yesterday a big outperformance of Europe over the US when that risk is starting to fade. The second one has been this big appreciation of the euro that is a headwind for European corporates. If that was to reverse, the bull case for European companies will be even stronger than we are at the moment.
But do you see this current level in Eurodollar as punitive for European equities? Because we've had various people come around and join us saying it's not yet there to that level, so it's going to hurt corporates or the European economy.
No, first of all, our FX strategists are expecting more appreciation of the Eurodollar. They have a target at 120, so they think there's more to come. Now, the reality is that we don't know how much FX hedge companies are. We don't know exactly in what currencies the contracts have been made, whether they were in euro terms, in dollar terms. So there's a lot of uncertainty, and I think this is why the analyst expectations around earnings for this year have been really stable recently. It's just because there's just a lot of uncertainty and people have been reluctant to change their expectation ahead of guidance from the companies on what the impact they expect to be.
Benedict, can I ask you about the read across from higher bond yields into stocks? Because we're seeing, Valerie was pointing out earlier to us that JGB yields were a little bit higher this morning, and there's limited read across into Europe, but there is some. We see German yields up by 3 basis points at the 10-year horizon. I wonder how you're thinking about that link between yields and stocks in Europe at this point.
Yeah, so the key kind of thinking is that higher yields tends to be negative in terms of refinancing rate, in terms of valuations. Now, we're not at level yet in Europe that are too punitive for stocks. The question was more a US story with the level of yields that were much higher in the US. We saw the yields coming back down recently, so that was less of a question. So I think for now, if you stay around current levels, I think the bull case is more open for Europe, and rates levels should be less of a concern for European stocks.
Benedict, we are monitoring, I should say, very quickly, Ursula von der Leyen speaking in Parliament right now. Looks like she's making comments around China as well and potential security implications there. I want to bring this back to you and put this in a little bit of context. We're talking so much about U.S. tariff worries. When it comes to pricing in equity market risk, should we be looking to the east instead?
Yes, exactly. So I think there was this overall over-focus on what's happening with the U.S., and I think the focus is slowly shifting away from this. And we've had some negative news around announcement in China last week, and that could be definitely a risk for European stocks. We know that we are quite dependent also on the East. So that is one of the things we're monitoring and that we have on our radar.
How are you viewing the possible deflation effects in Europe? We had a guest on earlier who was talking about, the fact that if these tariff rates on the U.S., on importers to the U.S. go up, that increases the chance that there is some dumping of cheap goods in Europe. Is that something that maybe European corporates are worried about when it comes to their price competitiveness?
Yeah, I think there is this overall change in the dynamic of the trade structure overall, and that will be implication. I think the worry on the inflation level is first and foremost one of higher inflation in the U.S. What could that mean for U.S. market, and what could be the implication for European market? I think the moment that is kind of the key focus for markets.
And that, in terms of volatility events, that's going to be something we watch, isn't it? Because we've got U.S., I think it's the middle of the month, we get the U.S. inflation print. So even before we get to August 1st, we've got to overcome that kind of hurdle. How would you expect markets to be approaching that news event, Benedict?
Yeah, so I think that print that we have next week in terms of the CPI in the US would be very key for markets. If we do have a more benign print, that could potentially open the door for that September cut to really be anchored in the market. And that would mean that it's a bull case for equities in the US if you start to price in more cuts coming for the US. Now, if we do get a higher print, that reopens or closes the door for that rate cuts to happen, that reopens the door for the Feds to remain on hold for the rest of the year. And that could be a disappointment for equities when you see that the rates market is still pricing in 2 cuts for the end of this year.
Well, Bénédicte, we've talked about the bond market, we've talked about the FX market. I think it's only natural to talk about the commodities market while we're at it. There's a big question here of whether we see some sort of commodity crash in the oil markets from major changes at OPEC policy, shale producers hedging, et cetera. If you do start to see that show up as lower inflation, how does that show up in the equity market?
Yeah, so we've seen the news around OPEC this weekend. Our economists do expect lower oil prices into year-end. That is usually a net positive for European stock because European Union as a whole is dependent on oil. We're not exporter, we're a net importer. So what tends to happen is that when there's higher oil prices, Europe tends to underperform versus the US. Overall, apart from the sectorial divergence and dispersion, that should be net positive for European equities, lower oil prices.
I guess final question on the outlook for European equities. Do you expect them to be outperforming or underperforming U.S. equities by the end of the year?
$1 million question. I think we are heading into the earnings season. The difficult bull case for Europe to outperform the U.S. over that time period is that there's going to be a massive tailwind for U.S. stocks coming from the lower dollar that we're not going to get. So I think once we get out of this earnings season, if the data is not too negative on Europe, then the bull case is reopening.
Right, earnings season is pivotal. Another guest coming on and telling us that this morning.
Okay, Bénédicte, thank you very much. Bénédicte Lowe, equity derivatives strategist for Europe at BNP Paribas Markets 360. Thank you very much for joining us, Bénédicte. Let's pivot from the equity story to what's happening in commodities. Kritty was talking there about whether we see this downward push in energy prices, what that might do to stocks. Well, let's focus in on the commodity side of things. This is the picture across a host of assets right now. You can see WTI down by 0.3%. Brent is down by 0.2% this morning. Let's get to Francisco Blanch, commodities and derivatives head at Bank of America Global Research, who's with us. Great to speak to you, Francisco. Thank you for joining us. We're, of course, dealing with a lot of tariff news flow, tariff headlines out of the US last night. The market overall, risk sentiment seems to be surviving this latest onslaught, seems quite resilient. What does this mean, big picture, for commodity markets?
Well, thanks for having me once again. So, look, I think commodity markets are certainly still vulnerable to tariff escalation. I think the trade war that started now, it's been probably almost 6 months ago, still moving commodity markets a lot. We've seen not just oil being impacted, but also copper, aluminum, of course, steel, which are at the heart of the tariff battle here. But the market is getting more used to it. And of course, one thing we've seen that is different to the first trade war during the first Trump administration is that we have a lot more stimulus going on. So we have the Chinese government pushing through enormous amounts of money into the economy. We also have the Europeans ramping up spending, particularly on defense, but also in other issues. And then, of course, we had the big, beautiful bill coming through the weekend, right? So there's a lot of money coming through, and this means the nominal economy will keep expanding. And in my mind, this could be a positive for commodity prices once we get through the trade tensions.
And Francisco, thinking about some of the things you cited there around fiscal spend and policy change and what that might do to the demand side, we heard from OPEC Plus, of course, as they increased production, that they were concerned about the demand side, the summer demand picture in particular, and that was one of the reasons that they had to increase production. Do you see that positive demand story evolving?
Well, I have to give credit to OPEC and particularly Prince Abdulaziz for reading the market, I think, probably better than most of people out there. We've had a lot of volumes added, at least via quotas. Of course, it's one thing to increase the quotas, a different thing to increase the volumes of production. These are two separate matters. So we haven't really had 1.6 million barrels a day, to be clear, added to the market. We've had less for now. But But the market's still in backwardation. The front-end prices are higher than forward prices, which is creating an incentive, of course, for OPEC to bring more barrels. And then secondly, I think there's another issue, which is the differential between light oil and heavy oil still very, very tight. And this means that refineries keep buying the marginal barrel that OPEC produces, which is Saudi heavy. So demand is robust. Demand is taking on the barrels. We've seen a strong diesel market this summer. Gasoline has been holding up, maybe a little less, but also seeing strong growth. So yeah, I mean, I think it's been a good time to add those barrels, and the market hasn't struggled for the time being to absorb it. Now, having said that, we are a little more negative into the second half of the year as we get closer to the shoulder season.
Well, Francisco, there's a question about where shale players come into this as well. You mentioned those demand and supply dynamics. In the last kind of price spike that we saw off of the war in Iran, there was a question of how many shale players hedged at those levels and are ultimately creating even more pressure to the downside. Francisco, how low can oil go?
Well, we are just to be clear, we are negative into the second half of the year. We think prices will fall into September, October. This is because we think there's going to be a surplus. We think there's going to be more supply, particularly given OPEC's latest quota increases, than there will be demand. And this means inventories will build, as they have, to be honest, in the first half of the year, and prices will fall. So that's our baseline scenario. We think that will happen to the range of 800, 900,000 barrels a day through the coming months. Now, having said that, remember, the first 6 months of the year, most of the inventories have built in China, and the majority of those inventories have built in China's strategic petroleum reserve. So inventories in Cushing are low. Inventories across Europe are low for crude oil, and inventories for petroleum products are also low. So we're going to have to see those inventory builds coming through before prices can come down to the levels that we target, which is probably in the, we think we'll go into the low 60s for Brent, and we'll probably hit again high 50s for WTI.
Francisco, just quickly, if you're a bit bearish on oil in the near term, what's your outlook for European natural gas, for LNG?
European natural gas, we think is going to be a tight market coming into the winter. We believe it will be hard to get to the 90% inventory target levels, 90% full inventory target levels that have been established by the European Commission. And part of it is that despite the fact that China's LNG demand is down 20% year on year, the world's still absorbing LNG at a pretty good pace, and Europe hasn't been able to build inventories.
Yeah.
It's very important that we build inventories. So we do think we'll be averaging probably roughly 40 euros per megawatt hour, maybe spike further. So it's going to be a tight market in our view.
Francisco, we have to leave the conversation there, but thank you so much for joining us. Francisco Blanch there from Bank of America. This is Bloomberg.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The constant change of position and the delay of the date at which the tariffs are supposed to kick in, I think just confirms that a tariff war benefits no one. It is really a lose-lose proposition. And from the European Union, we have every interest in finding a good outcome that will continue to preserve free trade.
European Investment Bank President Nadia Calvino talking to us about what the actual reaction function is over at Europe when it comes to that tariff policy. Let's dive into that subject a little bit more. Bloomberg has learned that the EU is seeking to conclude a preliminary trade deal with the United States this week that would allow it to lock in a 10% tariff rate beyond an August 1st deadline. Now, member states are reportedly divided on how imbalanced a deal the bloc should accept. Joining us now is Arantxa Gonzalez, Dean of the Paris School of International Affairs, and who had previously served as the Executive Director of International Trade Center and as Minister of Foreign Affairs in the Spanish government of Pedro Sanchez. Quite the resume, the perfect person to join us this morning. Arantxa, thank you again for your time. Walk us through that number, basically. I mean, we've seen a real turnaround when it comes to the European Union's disposition, going from 0 for 0 to maybe we'll accept 10. How much kind of appetite do you think there is for a rate, a level higher than 10%? How much do you think the EU would be willing to accept?
I think in Europe, the appetite for tariffs is pretty low. And it's pretty low because we know in Europe that tariffs don't help. They don't protect. They don't help you attract investment. If that is your goal, then you have to go and you have to look more at the structure of your own economy, at the factors that make for your competitiveness. Tariffs are just a tax that end up being paid by consumers. This is why the appetite in Europe is low. It's also the case that Europe prefers the route of a negotiation with the US. But Europe is also clear that it should not cave in to extortionary trade practices by the U.S. administration. So there are the ingredients with which the European Union has to play to land this into somewhere that would be as little damaging as possible. That's what we're looking at. We're not looking at good stuff. We're looking at making this as least damaging a situation as possible.
Arantxa, you have spent some time in the Spanish government. I think the kind of tone that the Spanish government right now is really taking in the face of these tariff negotiations with Washington is perhaps revisiting the relationship between Europe and Beijing. And I think that one's something that I think you can give us a little bit more insight to. Is the answer to dealing with the tariff threat from Washington strengthening the relationship with Beijing instead? Where do you stand on that?
No, I don't think this is a fair description of what the EU is doing or what it should do. The EU needs to have a strong relationship with the US. It's its main trading partner. It's its security and defense ally. It's just that this is not the way this US administration looks at its relationship with Europe. On the other hand, China is a systemic country to the world economy. is a very sizable part of world GDP, is 14% of international trade, is 30% of global emissions of CO2. So what Europe needs with China is to have a functional relationship. It's not replacing the US with China. It's not one or the other. It's the two, because the two are systemic and essential to the management of global economy, global emissions, and global stability, which is what Europe is looking for.
Arantxa, you started off there by talking about how Europe has little appetite for tariffs, but they do protect some of their own industries with their own tariffs, be it agricultural goods, wine and spirits, even their car manufacturing is protected by tariffs. If they don't have any appetite for tariffs, why wouldn't they lower their own tariffs in order to get U.S. tariffs to zero as well?
Well, this is precisely what the European Union is doing as we speak. The EU is negotiating with countries around the world, is negotiating with India, is negotiating with the United Arab Emirates, with Thailand, is negotiating with Malaysia, with Australia, with the goal of reciprocally reducing tariffs, if possible, bringing them as close as possible to zero. Understanding that the tariffs that exist are the negotiating chip that Europe, as well as the other countries with whom the EU is negotiating. This is the negotiating chips they have, and this is how they will get to a good deal. But this is what the EU is doing. The European Union is not afraid of open markets, is not afraid of negotiating with others, is not afraid of competing in the world economy. It's just that it does not want to trade with other countries with a gun in its head. It does not appreciate extortionary trade policies, which is a bit what is at the moment facing with the current U.S. administration.
Is there any sectors there? We just had a graphic on screen showing that the pharmaceutical industry in Europe could be the most affected by tariffs. Is there any sector that you feel like is at least having some political persuasion, maybe telling the EU that tariffs could destroy the industry in Europe? Which ones do you see as the most vulnerable?
No, I mean, it's pretty clear, and it's also very telling, Valerie, what we are hearing from the CEOs of the pharmaceutical industry. They are basically saying it's not tariffs that will change pricing structure of medicines in the U.S., which is, at the end of the day, what the U.S. president has said is looking at. He's looking at reducing the price of medicines to U.S. consumers. And it's blaming the European Union for the high prices in the US market. And we know that it's not European exports to the US that is the reason for the prices in America. This is a factor of the policies that the US has in place. So if the problem is one of prices of medicines in the US, it would be good to look at the structural policies in the US. But I would say, Valerie, pharmaceuticals is an important one. By the way, is a sector where both sides, the EU trades enormously with the EU and the EU trades enormously with the US. It's a clear example of win-win. Structural problems to the U.S. Pharmaceutical sector, for the healthcare sector, there are. Look at them and tackle them at home. Don't externalize the problems of the U.S. pharmaceutical sector.
Okay, so we'll see if we get any movement on those sectoral tariffs. I know we haven't seen necessarily all of the details on that yet. Can I ask you about tech regulation, Arantxa, and what we should be watching for there? Because the U.S. administration seems to want to factor the way that U.S. tech giants are treated abroad into a lot of the conversations right now. Scott Bessent, the Treasury Secretary, removed a clause within the Big Beautiful Bill when he said that the G7 moved on some of their tax policy around big tech. What should Europe be prepared to give up when it comes to tech?
Well, I think there is two parts to this discussion. One part is taxes. Another part is the regulations that are in place in Europe to protect citizens, to protect consumers, and to protect democracy from the abuse of technology, in particular in social networks or through social networks. And I don't think that this is an area that the European Union should trade with the US. I don't think the European Union should trade democracy, which is what a lot of these regulations are about, is protecting the ability of European democracy to work. So, I mean, on this one, on taxes, we've seen that there's been movements, although I have my own views on this one too. I would rather make taxation be fairer on both sides rather than give American companies a pass. But on regulatory frameworks that are to protect consumers, citizens, and democracy, I don't think the European Union should trade that.
Arantxa, I know that obviously Brussels negotiates trade policy on behalf of the EU, but President Trump has liked to try to pick holes and pick apart the European Union on occasion, including quite recently flagging Spanish resistance to spending more money on defence. Do you think that that is going to possibly be negative for Spain when it comes to its relationship with the United States?
No, I don't think, first, it's pretty clear that this is the European Union Treaty. Trade is a community competence. No single European member state negotiates trade with third partners. It's done by the European Commission, and it's done on behalf of all EU member states. And, you know, if you want an example, you know, we've seen attempts by EU leaders to kind of be nicer, kinder, more sympathetic to the US administration. But when the US has imposed tariffs, it's imposed them on all European Union member states, whether these member states were nice to the US or not. Tariffs on steel, tariffs on cars, and the 10% overall tariff have applied to all EU member states. So I think this is where the EU's strength is, in its unity, which is why I'm not too concerned about the US picking on one or two or three member states individually.
But Arantxa, what message does that send? I mean, we know that Spain has now gotten this exemption from NATO, as Anna was just mentioning there, but what message does it send in terms of a unified approach from the EU, whether it comes to trade or whether it even comes to defense spending to NATO to defend European borders? If Spain gets the exemption, does that not create a roadmap for everyone else?
Well, what I would say is that it is important for all European Union member states, including Spain, to increase its security and defense spending. And Spain has just done that, is in the process of doing that because it needs a new budget to do that. But the signal that the government has sent is increase significantly spending on security and defense. Why? Because the international environment has darkened. It's more brutal today than it was in the past, and Europe needs a serious defense. But I would also say that in addition to spending more, what we need in Europe, and presumably this is what we are looking at NATO to do, is a clear deterrence posture. What we need is all members of NATO to clearly commit to defend other NATO members if ever there is an attack on them. And this is where we've had a bit of a question mark when the president of the US has put into question its commitment to the defense of the European continent. So yes, Europe needs to spend more. Yes, I'm convinced that Europe will do that, including Spain. But yes, what we also need is a clear deterrence posture. This is what Europe's enemies need to hear loud and clear. And if we are not clear on this one, we are weakening our ability to defend ourselves, and spending more cannot be a substitute for that clear deterrence posture that we need.
Well, Arantxa, you're very clear on that deterrence posture, and you emphasize the fact that all of European countries, including Spain, need to be spending more, but there's more, and then there's 5%. There is a bigger gap between the 2.1% of GDP that Spain has committed to or gotten the exemption for relative to the 5% and the money and the kind of eating into the welfare budgets that every other country is enduring in favor of that defensive posture. My question to you here is, why are the numbers not the same? And is there some secret sauce here, ultimately, to getting to the same defense capabilities for less money? Does Spain have a solution that other European countries are not thinking about?
Well, I think on this, we have to listen very carefully also to what the International Monetary Fund is telling us. And what it is telling us is that we have to do this increase in spending, while at the same time making sure that we engage in fiscal paths that are sustainable. So to me, it's less about a magic number, and it's more about sending a clear signal and having a path where Europe does more on security and defense, spending more, but also spending better and also spending together. And we've made a lot of putting all of this into a number, which in my view may not necessarily capture the complexity of this conversation. So rather than looking at a number, I want to see a clear sense of direction in spending more, in spending better, and in spending together. That, in my view, together with a deterrence posture, is what will convince Europe's enemies that Europe is capable of defending itself.
Arantxa Gonzalez, thank you very much for joining us. Dean of the Paris School of International Affairs, former foreign minister in Spain. Let us check, Val, what is going on the euro. Quite a lot of strength. Is this all trade-related?
I mean, it could be around optimism about a 10% deal that we had reports of earlier, a 10% tariff deal, I should say, between the U.S. and the EU with some carve-outs leading to this positivity in the euro this morning. It's nearly unwinding all of yesterday's weakness. Remember, we had quite a bout of dollar strength yesterday. Our own Mark Cudmore from the MLive blog was saying that was just a positioning squeeze, that the near-term low for the dollar isn't here yet, but we are seeing quite a reversal at the moment when it comes to euro-dollar strength, almost totally wiping out its weakness of yesterday.
Venram reminding us that at the beginning of the year, or actually the end of last, we were all talking about when we were going to get parity. Things look a little different right now.
A complete whirlwind in just 6 months' time to see this reversal. But that's the risk that we were just talking to Benedict Lowe as well, in terms of if you see a swing back in the other direction, how punitive is that for American companies, for European companies? What is the ripple effect? That's maybe something not people are thinking about.
Depends on when you've hedged, I guess.
Yeah, absolutely, as to whether how painful this is. Okay, let us tell you what is coming up on the programme. Coming up, Emmanuel Macron is set to land in the UK for a state visit, mixing royal pageantry with some thorny political conversations. We will discuss what to expect from the French president's 3-day visit. Details next. This is Bloomberg.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter. But it's bad for the product. It's not good. After that, I'm never doing that again.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jumana Versace in Doha, Qatar, and this is Bloomberg.
Welcome back to the opening trade. We're about 49 minutes into today's session. It's not a very exciting session, I will admit. The DAX is higher, though. It is the outperformer of the day, higher by about 0.2%. And I think that's all you need to know. I think we're waiting for a little bit of a rebound, a little bit more of a direction from those U.S. markets.
This market does no justice to the news flow, does it?
No, I was going to say, it's a summer Tuesday.
Well, let's take a look about some other potential catalysts for the market. We are light when it comes to economic data today, but plenty to watch when it comes to politics. Later, the French President Emmanuel Macron's first state visit to the UK will begin. We'll have more on that story in just a moment. Also, we have the EU economic and finance ministers meeting in Brussels. And later today, Amazon Prime Day begins. Their annual sales event begins through July 11th through Friday, with maybe some hints on how the U.S. consumer is shaping up. Anna.
I struggle. I have nothing interesting to say about shopping, but I'm sure many others will. Now, the French President Emmanuel Macron is due to arrive in the UK later this morning for the first state visit by a French leader since 2008. There'll be lots of pomp, lots of ceremony, but also plenty of really serious topics on the agenda. Let's get a briefing now. Bloomberg's Alex Morgan joins us on set with a look at what to expect. Alex, good morning. So what does the schedule look like? What's involved?
Well, it's a pretty packed three-day schedule. I mean, I've said in the past I've got a busy few days. I think this is actually what a busy few days looks like. It is pretty intense. I actually can show you a little bit of what's to come. So the French president arriving with his wife today, greeted by the Prince and Princess of Wales at RAF Norfolk. That's a very senior royal welcome for the president before being conveyed to Windsor, not Buckingham Palace. Now, that's because there's renovations taking place here in London. There'll then be a welcome by the King before Macron will be back in London addressing parliamentarians before heading back for a state banquet tonight. Wednesday, we move from the sort of pomp and the ceremony into sort of the political discussions, a bilateral meeting with the Prime Minister, Keir Starmer, before a banquet here in the city of London in the evening, if anyone's peckish and wants to pop over. Before Thursday, we're shifting more to look at defence with Starmer and Macron. In the morning, they'll be chairing or co-chairing the 37th Franco-British Summit, and then there's a meeting of the so-called Coalition of the Willing. You remember those nations pulled together when it looked like we might get a hasty end to the Ukraine war, which would require countries like the UK and France to step in and hold the peace. So a busy few days, ending on a joint presser from the two leaders on Thursday.
Alex, are we expecting any, I guess, serious discussions to lead to serious breakthroughs when it comes to defense and the migrant issue, which I know is on the agenda?
Yeah, I think, for me, I was looking at this and thinking about this. Really, it feels to me like a state visit of two flavours, if you like, of two sides. There's the hard edge of the UK soft power, which is deploying the King, the royal family, in a way that the UK really is quite unique in doing. The state visit emphasising the sort of post-Brexit thawing and a new entente cordiale between the UK and France. We know that's something Keir Starmer is very keen on. Migration, though, is quite literally and metaphorically a sort of a dividing channel between the two, the small boat crossings being a huge issue politically for Keir Starmer in the UK. Whether or not we'll get an inked deal on a new sort of returns framework from the UK and France, whereby migrants who make the crossing will be returned, we don't know. But when it comes to security and defence, of course, that's another shadow that's been cast right the way across these few days. But we also know that trade and investments are another part that the leaders want to be talking about. Thin on the details at this stage, but there'll be this bilateral meeting on Wednesday and then the Franco-British Summit where maybe we'll tease out some more details. But the mood music very much is two countries trying to emphasise that Brexit, the B word, is behind us. There's an emphasis from these two leaders of moving forward, thawing things out, and I think trying to put on a good show despite some of these larger issues casting those shadows.
Yes, and coming a long way in terms of that bilateral relationship, Chrissy, from the days when Liz Truss was Prime Minister and was asked if France was friend or foe, and she wasn't entirely sure she could answer the question, said the jury was still out. So things have really changed a lot when it comes to these two countries.
It's a hard question. Bloomberg's Alex Morgan giving us the details of that state visit. We thank you so much. Let's stick with some of the UK news with a little bit of a corporate flavor if we can. Now, Schroders, a 221-year-old City of London financial institution, facing a pivotal moment. Speculation growing that the Schroeder family, which still holds a 44% stake, might consider selling or breaking up. the company. Leo Kensherper is all over the story, our asset management reporter. Leo, what has gone wrong for Schroders?
Yes, thank you very much. So the challenges Schroders is facing are very similar to the challenges that other traditional active asset managers are facing. You know, when you look at their bread and butter mutual funds business, you can see that costs are rising and revenues going down, and that's because investors switch to cheaper passive funds. Schroders also has a private markets business, which essentially consists of a lot of businesses that Schroders has acquired over the years, you know, a Swiss mid-market private equity firm, a renewable infrastructure manager. But on the whole, these businesses don't move the needle enough for Schroders. And the business has missed fundraising targets over the past years. And now what adds to the pressure for Schroders is that they're not entirely owned by the family. The family owns 44%, and the rest is publicly listed. So the share price has now dropped more than 40% from its peak in 2021, and you can really see that investors' patience is wearing really thin.
It's not the first time that the Schroeder family has felt under pressure in this sense, Leo. What's the backstory here?
Yeah, so the parallels are really striking. In the 1990s, a lot of UK investment or merchant banks, you know, the likes of SG Warburg, Kleinwood Benson, they have decided to sell because essentially Wall Street giants were increasingly eating their lunch. They had bigger balance sheets and were winning more and more business as a result. And Bruno Schroeder, the dominant figure at Schroders for decades, also decided to sell to Citi for £1.3 billion. And that move really served them well. I have to say, they sold during a boom time for investment banking, and they avoided, of course, the worst of the great financial crisis. So yeah, that turned out to be a really good call. And now, 25 years later, you've got giants, asset management giants, also from the US, coming for Schroders on both sides of the fee spectrum. You've got passive giants like BlackRock, who have taken in, I think, nearly as much net new client money over the past 2 years as Schroders has in total. And of course, you've got Blackstone, private market giants, who are also winning more and more market share. So many people in the city are wondering if, you know, history is repeating itself.
All right, Bloomberg's Leo Kensherper walking us through history potentially repeating itself. We thank you so much for walking us through the Schroeder story. It's fascinating. We've got a lot to digest in terms of today's trading day, what could come ahead. A lot of the focus, at least in the UK, while these markets aren't really reacting, seems to be the state visit from Macron, what's going on in the banking industry. I wonder if that changes in a couple hours' time.
Yeah, I mean, we've got markets pretty quiet, aren't they, dealing with this change of date, this moving goalpost. And, you know, I came into this morning thinking, or last night thinking, we've got to hear from Europe because that deadline still applies. And actually, that deadline has for all trading partners has been moved to August the 1st. And so that's not the case. And so when we hear from Europe, again, another moving feast, waiting to get some kind of confirmation on them being able to achieve a 10% tariff, which compared to lots of other countries would be seen as a win, perhaps.
Yeah, no, you can say that European stocks aren't really moving today, but they did close at the highs, even with Wall Street declining into the close. So they're doing pretty well today. Same with the euro-dollar as well.
They have moved. Coming up, the Robinhood CEO joins the Pulse. Don't miss that interview. That's in just over half an hour's time. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
President Trump fires off a new wave of tariff threats, but puts them off until at least August the 1st while negotiations continue. The EU rushes to seal a trade deal with the U.S. to lock in a 10% tariff rate. Plus, in a policy U-turn, Trump promises more weapons for Ukraine and rebukes Vladimir Putin for keeping up attacks. Now, this is the markets. Let's start cross-asset because stocks firmed as there were early jitters over the Trump administration's latest tariffs announcement. Now that seems to be giving way to a little bit of optimism that there's ample room for further negotiations. S&P futures, you can see gaining a touch. Euro dollar 117.59, Brent crude 69.25. Now, of course, the European Union seeking to conclude this preliminary trade deal with the U.S. this week. It would allow it to unlock a 10% tariff rate beyond August the 1st. So let's also look at the European markets map. Now, of course, unlocking anything beyond August 1st means that they would negotiate a more permanent agreement after that. And the picture for European stocks pretty much unchanged. Just the DAX is gaining some 0.2%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg understands that the EU is seeking to conclude a preliminary trade deal with the U.S. this week that would allow it to lock in a 10% tariff rate beyond the August 1st deadline. But President Trump has hinted that the deadline could be extended further.
I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
Now, for more on all of this, we have team coverage. Let's bring in Rufaro Kirisari, Fixed Income UK Head at RBC Wealth Management, Rosalind Matheson, our EMEA News Director, and Brendan Murray, our Trade Czar. Susan Lynch, our Brussels Bureau Chief, also joins us. First of all, Brendan, I mean, letters were sent saying, look, he'd be happy with the kind of duties that he imposed, but at the same time, negotiations are open. What does the president want?
Yeah, well, 90 days was always going to be an optimistic timetable to put together any sort of comprehensive trade deal with each of the U.S.'s major trading partners. And what the president laid out in this letter, these letters yesterday, which were pretty much boilerplate for the various countries, just with different tariff rates in them, he said, look, there's time. Essentially, what he said was, look, there's more time if you want it, but if not, August 1st is the new deadline. So he basically said there's more flexibility than I initially gave. The July 9th deadline has been the marker that they have laid down for 3 months. So it's buying the administration a bit more time and some of these countries a bit more time to bring deals that had gotten bottlenecked at the finish line across the president's desk.
Yeah, and Rufaro, that's kind of like playing out in equity markets, but also in bonds overall. Is that there's a little bit of hope that actually negotiations can be ongoing and lead to a better outcome.
I think certainly when we sort of think of the reaction that we've seen in the bond market so far, it's been, I suppose, positioning for that sort of slightly better outcome that a deal will be reached. We certainly don't see talks sort of breaking down in this sort of scenario, but we think there might be some concessions that may need to be made around perhaps some of these sectoral sort of aspects. So while there is good news, I think there's still some way to go.
And Suzanne, I mean, from the European Union side, they're trying to, to basically deal with this preliminary trade deal, and they want to carve out wine and spirits, aircraft and aircraft parts.
Yeah, and I think the key phrase here is preliminary. This would be a very broad brushstrokes kind of deal that the EU is trying to finalise before the end of the week with that 10% reciprocal rate. And as you say, they're trying to get some carve-outs for certain sectors. But in parallel to this, if you like, you've got the whole issue of sectoral tariffs. So tariffs on steel and aluminium, auto sector, even pharma tariffs. Now, they haven't come yet from the US, but the United States is investigating this and could impose pharma tariffs. They are kind of the big headache for the EU, because if they were to get this 10% rate, even with some carve-out, and get nothing on those bigger export products, those sectoral tariffs, well, then they have to have a problem. So I think the atmosphere here is quite cautious. I don't think it's necessarily seen as a huge positive that, it's been delayed once again. Germany in particular has been saying for the last few weeks very strongly that it wanted this wrapped up quickly. Now we have another extension now in the interim period to August 1st. So by no means, we're cut and dry on this yet.
Yeah, and Susanna, we also spoke to the European Investment Bank President Nadia Calvino. This is what she had to say about tariffs.
The constant change of position and the delay of the date at which the tariffs are supposed to kick in, I think just confirms that a tariff war benefits no one. It is really a lose-lose proposition. And from the European Union, we have every interest in finding a good outcome that will continue to preserve free trade.
Roz, are partners just getting used to the fact that this is maybe the way that Donald Trump operates? He escalates and de-escalates, and at the end of the day, we'll end up with tariffs that the global economy can absorb.
Well, certainly with Donald Trump, nothing is final until it's absolutely chiseled into concrete. That's what we're learning, is that this administration moves very quickly, but also changes very quickly. And Donald Trump is very open to continuing to talk. And as we've been discussing here, like on the one hand, that buys countries time. On the other, it just extends the uncertainty over a longer period of time as well. And we can see from these initial frameworks that have been done, also they don't fix everything. So you've got these deals that he's announced with Vietnam, although Vietnam hasn't really confirmed that, with China and the UK. But even for the UK, implementing what they said they've agreed has been difficult. There are disputes still over steel. What defines steel? Where is it poured? That's very bogged down. And so you can see that even a very broad framework that the UK came up with, getting all of that bedded down is difficult. So for other countries still pushing this down the road, trying to get something that avoids a high level of tariff, but still going to be fraught with problems.
Yeah, and we're just getting, German exports actually sank more than anticipated. And again, this is because the value of shipments basically to the U.S. plunged to the lowest level in 3 years. When are we going to have more data points like this that point to actually chief executives not spending, cutting down on, some of the investment that they would have otherwise, and train being shifted around?
Well, sort of looking at sort of the German picture, we actually had some slightly more positive data yesterday. But of course, the front running that we saw in Q1, that's effectively borrowing from future quarters. We actually have a more positive view in terms of euro area growth in general. We're expecting sort of growth of 1.3% this year. And that's really feeding through from that stronger than expected Q1 period. But also it's also the fiscal spending that we think will actually come through a bit earlier from Germany. And also ultimately it's that consumer spending as well, where we've had high savings in the euro area. We expect that to feed positively into growth as well.
Brenda, who's getting the tougher tariffs? Again, it feels like maybe it's a little bit more calculated than the first time around.
Yeah, it looks like they're coming in just a bit under what the original reciprocal rates were. So, time is on the side of the U.S.'s trading partners. I think one of the things that this 3-week pause will do, though, is we'll cut straight through the heart of this next earnings season, and the cloud of uncertainty that hangs over companies who are facing these tariffs are now going to say, we still don't have any visibility out into the third quarter or the fourth quarter into those costs. So while it buys time for trading partners, the companies that are paying these tariffs are still struggling to figure out how they're going to operate in an environment where they don't know what the future holds.
We also heard from President Lula of Brazil. Here he is.
Presidente da República de país do tamanho dos Estados Unidos.
A president of a country the size of the United States to go around threatening the world on the internet. It is not right. He needs to understand that the world has changed. No, we don't want an emperor. We are sovereign nations. If he thinks he can impose tariffs on countries, countries also have the right to do the same.
Ross, I mean, you hear this from a couple of leaders, especially from the emerging markets or from the BRICS countries. I mean, is trade being fragmented, or is there a pool that's coming together in some part of the world?
Well, that's one of the reasons that Donald Trump doesn't like the BRICS, is because that group is expanding and it is accounting for a larger proportion of the global economy. But whether they can act as a proper group remains to be seen. We saw at the BRICS meeting that we just had on the weekend, some leaders speaking out, but others, frankly, trying to be very quiet when Donald Trump talked about a 10% tariff on BRICS countries for being anti-American. They didn't really want to engage on that. They seemed to want to let that fly by. So collectively as a group, they account for a lot of the economy and trade and output. Are they able to act as a true collective against the US? Unclear. I mean, also some of these smaller economies just frankly don't have the clout, the ability to get a trade deal with the US. They kind of have to swallow what's coming. If you're a bigger economy, you can negotiate better. And so they're a little bit at the mercy of what the US wants here. But again, you can see from, Brazil has been quite vocal. South Africa was a bit vocal yesterday also. But again, the smaller economies, when you look at Cambodia, Myanmar is another one, a lot of these smaller Southeast Asian states, they don't have a lot of ability to band together to do anything.
And far is this playing out actually on either, the fixed income or the currency markets for some of these countries?
I think certainly from the markets that we sort of cover, sort of looking at sort of the UK market, we certainly haven't seen too much of a reaction in terms of that happening, given that the UK has a trade deal already. We did see sort of yields sort of track a bit higher across the UK and European markets as well as the US markets. But we think part of that was just a reaction to some of the jobs data that came out on July 4th. But I think predominantly some of the fiscal aspects may be the aspects that start to play into where yields go from here.
And Suzanne, when you look at the European Commission, of course, which handles trade matters for the EU, first of all, it seems that, Donald Trump and his team are okay to negotiate with them. We thought that maybe he'd come in and try and break them apart and play the leaders off each other. And, at the end of the day, would they get one of the best deals if things go to plan?
Well, that's what they're hoping. But, I mean, you're right there. It is the European Commission negotiating on behalf of the EU. But the EU member states, particularly those big countries like Germany and France, they all have to sign off on this. So, I mean, I don't think you're going to be hearing language like we just heard from President Lula from any of the big European leaders. But there is a conversation happening here about, how far should the EU hit back? They do feel they've leveraged. They've got sanctions ready to putting back on that, and they're continuing to. They don't want to escalate the situation. But I think there are a lot of nerves here. What kind of deal is this going to ultimately be for the EU? And if it's not good enough, are they right to sign up to it? We'll see if they sign this provisional agreement by the end of the week. That will give some calm to the situation. It will buy them more time, but those bigger questions remain about sectoral tariffs and other parts of the trade relationship.
Yeah, in pure geopolitics, Ross, I mean, there's also two other, significant things that happened. So Benjamin Netanyahu nominated Donald Trump for Nobel Peace Prize. I don't know whether that changes his thinking and also makes him cool off maybe on trade a little bit. And then the fact that we seem to have a reversal from the Trump administration on sending weapons to Ukraine.
Well, that's right. So all of this in Donald Trump's world merges together. So geopolitics, trade, these things all become one. And so your personal relationship with the president matters a lot. We can see that for Japan, for example, the late Prime Minister Shinzo Abe had a very good relationship with Donald Trump, and that did arguably diffuse some of the tensions over, paying for the US military in Japan, the trade relationship. And if you've got that rapport, it can help. And Benjamin Netanyahu clearly does still have that rapport with Donald Trump. There's been a few tensions there of late over the Middle East. Donald Trump frustrated that he hasn't got his ceasefire in Gaza, and we didn't see a lot of tangible progress in their meeting last night about that. There is a bit of a movement towards a ceasefire, but a lot of obstacles remain. Instead, he's trying to leverage the economic relationship in the region with Israel to get Benjamin Netanyahu to agree to the terms of a ceasefire. So it's about pushing on the trade and investment front there also.
So I wanted to talk about the UK in just a second, but Brendan, maybe first, what are you looking out for in the next couple of days? I mean, it's letters that get published on social media, but is there, are they telling these countries before face-to-face?
Yeah, I think the main thing is, where are the deals? The president pre-announced the Vietnam deal last week. It hasn't materialized. If that doesn't get over the line by the deadline tomorrow, you gotta wonder what happened. And also, you mentioned the BRICS. What about India? They've been talking for weeks about how an India deal is close, and if that is now pushed back to August 1st, why couldn't they get that over the line? So I think the main question now is where are the deals?
Yeah, I want to talk about the UK. I mean, the UK signed, right? They got it. They have a deal, or are they still? They have a
limited framework of a deal that still has a lot of details to be worked through.
But I guess the problem is UK growth, also given what we heard last week with the benefits welfare fiasco and what that means for inflation and labor.
Mm-hmm. So I think from the UK perspective, if we sort of think of that growth picture, similar sort of situation as to what's happened in the EU. Q1 growth is essentially borrowed from future quarters. We expect growth in the future quarters to be lower in the UK. But then coming into that inflation picture, we certainly see that wage growth dynamic continuing to improve. Of course, the lagged data is not necessarily where it needs to be, that 3 and 3.5% level. But ultimately, the CFO data coming from the Bank of England survey points that wage growth is expected to trend towards 3.8% towards the end of this year. That should prove to be positive for inflation. And on that basis, we think the BOE could ease 3 more times to 350 at the end of this year. But of course, that inflation dynamic continues to be a risk to that view.
When you look at fixed income, does it really, do these trade negotiations matter when it comes to choosing gilts over German bonds?
To a degree, and I think it just depends on the investor, depending on where they want to be exposed and their currency hedging costs as well that need to be factored in. But we think ultimately looking at the picture of fixed income across the board, we're certainly not a fan of holding ultra-long bonds, but prefer to be sort of shorter, intermediate part of the curve, just because of that fiscal sort of dynamic still playing out in that long end of the curve.
Okay, thank you all for joining us. I love team coverage on big days like this. Rufaro Kriziriri from RBC Wealth Management, Rosalind Matheson, our EMEA News Director, Brendan Murray, our Trade Czar, and Suzanne Lynch, our Brussels Bureau Chief. Now, coming up, deal-making activity is on the up. Maybe finally, a little bit, as loan issuance in Europe hits record volume. So we'll dig deeper on that. That's next, and this is Bloomberg.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Now, deal-making has had a bit of a wild ride this year. 2025 began with confidence about an M&A boom under Donald Trump, only for this enthusiasm to be stamped out by tariff threats and trade uncertainty. But now, deal-making has found its footing again, with around $1.8 trillion of transactions in the first half of this year. Well, joining us now is Danielle Rudnicki-Schlumberger, head of EMA Leveraged Finance at JP Morgan. Danielle, thank you so much for joining us. Look, there's a lot to talk about. How do you see the M&A pipeline for the second half of the year?
First of all, thank you for having me, Francine. It's lovely to see you, and indeed such a good time to catch up because so much has been happening. Deal making, M&A related pipeline for the second half of the year is getting better. We're seeing good signs. We're started to see some large cross-border LBOs coming back. Walgreens, Alliance Boots, 24 billion, Skechers, 10 billion. We're seeing now the contested takeover for Spectres, which is 5 billion pounds. We've underwritten more new leverage financing in the past quarter than at any point in time since 2021. But still, it's very little in terms of the volumes we've seen year to date. It's only about 20% of the volume, which is a very, very low number compared to long-term averages.
Danielle, I mean, why is that? So strong, we've had definitely strong equity markets. And I don't know whether, strong equity markets and heightened valuations mean that it's a good thing for M&A and IPOs, or whether they hinder it.
Well, let's put it that way. It depends on the sector. What we've seen is M&A or M&A for financial sponsors being concentrated in easier sectors. You've had to find this very volatile environment, sectors that are not too tariff exposed, that are not too cyclical, that show a little bit of growth. So the field of the possible has been reduced.
So given all of the risk appetite amongst banks and everything like that, can private credit also compete to finance some of the deals?
Yes, absolutely. And we've seen that in particular in April. April was a very interesting case study for us of what happens when there's a market wobble, right? During the month of April, we saw cost of leveraged debt increase by around 150 bips. And what we've seen almost immediately is private equity funds pivoting from broadly syndicated term loan Bs to direct lending loans, right? And that's why we've taken that into account. Now, our clients come to us for debt, right? They want debt cheap if possible. So that's why we've decided, JP Morgan, to do direct lending within leverage finance. So we've got this pocket, about 50 billion, so that we can offer A or B or C, whatever the right solution is, depending on the market. I would argue that having private credit now almost makes our market safer because there's an escape valve to be able to continue to do deals and distribute debt, even if there's a market wobble.
Danielle, what can you tell us? So you mentioned, the Sycamore Partners buyout of the UK pharmacy Boots. I mean, I think you're sounding out investors for a mid-July launch for this $4.2 billion debt package. Is there investor appetite? Does it feel good, or does the tariff threats distract investors?
I mean, generally, there's very good investor appetite and lender appetite for debt, in particular in defensive sectors. And as far as tariffs are concerned, they're going to look at it name by name, right? You really have to do the analysis. And in a way, we're lucky in our markets because we can really open the hood, open the bonnet of what's happening in companies, and to figure out what is the real impact of this thing. That's a really, really good case study is what we did on Skechers, right? We did the analysis, and we realized that under certain scenarios on tariffs, the impact on a pair of sneakers would be, you know, just 1% or 2%, right? It's so it's very difficult from the outside in without doing the real due diligence to figure out what the real impact on companies is.
The problem is that we don't know at the moment. So I was speaking to the owner of a big drinks company that was saying, look, 10% we can absorb, 20% is going to be a little bit more complicated. So do you see a shyness, for example, a lack of investment for the future because of all of this uncertainty? And how does that translate into M&A?
So, of course, we're taking it into account. And of course, the volatility weighs on us. Yeah. Sectors that are more exposed to such volatility will be a lot more difficult to get transactions done in. So we're seeing that weighing, yes. But at the same time, leverage finance is about debt, right? So we're less exposed than the equity markets overall. That said, it's the next couple of months the visibility for the next couple of months remains limited because there are just so many factors of uncertainty. And that's probably why we had such a huge refinancing wave in the past couple of months. I mean, it is literally crazy. We've issued 220 billion of leverage loan and high yield in the first 6 months of the year. That's a quarter of the European market refinanced.
Do you see a lot more opportunities in Europe than elsewhere?
I think there's probably renewed interest in private equity funds for Europe, yes. Okay. Some funds have purposely decided to focus on Europe now. And then there are subsectors that also offer really, really interesting opportunities. Think about defense, for example.
So, and again, so is defense something where you're expecting possible M&A? Like, are there certain sectors in terms of leverage finance where you're generally much more optimistic than others for the next 6 months?
Yeah, I mean, defense, to continue on that theme, is a huge area of focus for us, right? We've just done a 2 billion bond issuance in euros and dollars for CSG, which is the largest manufacturer of small ammunition to Czech company. That's a deal that would not have been possible 2 years ago. The needs in defense are just huge, and many SMEs in Europe, in particular, are finding it really hard to finance themselves, right? And you know, our direct lending, we're doing a lot in direct lending with these companies, but it's at a scale that is hard to imagine. The CEO the other day was telling me, look, I've got 2 factories, I just need to build 2 more, right? So for defense in Europe, it's really a call to arms.
Thank you so much. Daniela Schlumberger there, head of EMEA Leverage Finance at JP Morgan. Coming up, having revolutionized share ownership for retail investors, trading app Robinhood is rolling out blockchain-based tokens. It's not without controversy, though, so we'll be speaking to the Robinhood chief executive. That's coming up next, the conversation with Vlad Tenev. This is Bloomberg.
case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years. And how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB forum in Central Portugal, and this is Bloomberg.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London, and these are your top stories. President Trump fires off a new wave of tariff threats, but puts them off until at least August the 1st, while negotiations continue. Now, the EU rushes to seal a trade deal with the U.S. to lock in a 10% tariff rate. Plus, in a policy U-turn, Trump promises more weapons for Ukraine and rebukes Vladimir Putin for keeping up attacks. Now, Robinhood is credited with changing the game for U.S. retail investors, helping make it accessible to everyone. Now they're stepping into the world of digital assets with the launch of their own crypto tokens. Now, to talk more about that and its ambitions for Europe, I'm joined by Robinhood Chief Executive Vlad Tenev. Vlad, thank you so much, as always, for giving Bloomberg a little bit of your time. So first of all, have you had any inquiries, any queries from your local regulator in Lithuania regarding this offering?
Yeah, so what we announced last Monday in the south of France are several products for the EU stock tokens, which give exposure to public listed equities. We have over 200, and those are available 24/5, finally giving our European customers exposure to U.S. stocks. And then we did a giveaway of what we call private stock tokens of OpenAI and SpaceX. And those aren't tradable yet, but it's sort of testing the waters, if you will, for what we believe is a huge opportunity to resolve one of the biggest iniquities in capital markets, which is the fact that you have these massive companies that are staying private longer. In many cases, they're in frontier industries like AI, where we believe that could change everything, but retail investors can't get exposure. So we're working to solve this.
So the regulator in Lithuania, which you're regulated by, I mean, he looks at the offering and he calls you and asks you what?
Yeah, I think they have some questions. You know, they want to make sure that everything is proper because it's a new innovative offering, and we're confident. We think that these are not only important, but they'll withstand the highest form of scrutiny. You know, when Robinhood does anything, particularly if it's new, I think we expect that it's going to be looked over. So we do believe that it's important and will ultimately withstand the scrutiny. So we welcome the discussions with the regulators, as always.
Were they worried about risk or the way it was packaged? And have you been able to assuage, or is this just, I mean, when are you expecting to launch some of these tokens?
Yeah, so at first they were in the form of a giveaway. Okay. So we gave away around $1 million worth of OpenAI tokens, 500,000 worth of SpaceX. And the idea would be to eventually allow for them to be traded by customers and also to greatly expand the realm of tokens that we offer. We'd like to have thousands of private companies on the platform accessible to retail. And actually, since our announcement, I've had a deluge of inquiries, private companies that actually want to access retail, to have their shares tokenized, to be a part of this revolution. So I think that it's going to be a thing. Of course, it's always difficult to be first, but I think this is so important that we're very motivated to find a great way that satisfies everyone.
And Vlad, did you speak to any other regulators prior to developing these or launching the stock tokens for private companies?
Well, so they're live in the European Union, not live in the UK or the US yet, although we're very keen to find a way to give retail exposure to private companies here. And of course, we have ongoing discussions with all of our regulators as part of the course of running a regulated business.
And confident that they'll be happy with it? I mean, it'd be wildly exciting, right, if it were, for example, launched in the UK. What kind of things are they asking you to do to make sure that it's fine to do?
Yeah, I mean, I'm not sure the full extent of their questions. They probably just want to make sure that everything's clear to customers. I think these are new products, and my assumption is they just want to make sure that they are available to customers and it's clear what customers are getting. So in that way, I think we're very aligned because we want those same things. And we do think that the product is clear and is useful.
So, Vlad, how exactly are these tokens, the tokens are structured compared to the underlying assets?
Yeah, so the way tokenization works is we hold the underlying, or it's held by a U.S. broker or other traditional financial business. And then we have a tokenization engine, which basically mints for new tokens when customers acquire them. And if customers want to sell them, we burn the tokens. The mechanism slightly differs depending on the asset, whether it's a public stock or a private company. But the intent is for the tokens to be backed by exposure to the underlying asset in pretty much all cases.
So if it's a private company, how are you valuing it?
Yeah, that's a good question. Without getting into the details of private company valuations, there is a secondary market for private assets. And typically that market is institutional or high net worth in nature. So institutional investors, high net worth, are exchanging private shares or private exposure to companies with one another on a negotiated basis. And so what this would do is it would unlock that. So it's not just the high net worth institutional market, but it unlocks it to retail exposure as well. And the innovation, the difficulty has not just been the sort of like accreditation requirements in the US, but it's also been how to get the liquidity. And I think that's where tokenization comes in, because it solves the liquidity problem by tapping into a global network of hundreds of millions of crypto market participants.
Vlad, on a very basic level, would you categorize these tokens as tokenized equities or derivatives?
These are derivatives, technically speaking, under EU MiCA and MiFID regulation. So what makes this possible now is clear regulations in the European Union for crypto assets. So it's a bit of a new thing. It's crypto assets, but also a derivative, and those two things are being put together.
I mean, in case of a dispute, inevitably there will be probably some dispute that comes up. I mean, will you intermediate in some capacity on these tokens, or is that one of the things that you're still trying to figure out?
Yeah, I guess it depends on what type of dispute. I think one of the big questions about things that have been tried before in this space is dividend rights, for example. And if you have these instruments, customers in the past have been denied the dividends. But we've actually managed to figure out how to give customers exposure to that. So we want to give all the benefits of the crypto technology and of holding the underlying assets with as few compromises as possible. And I think Robinhood is rarely sort of like the first mover in various spaces. We tend to have an approach where we like to make sure others sort of like do it first. And I think in this particular case, we think it's so important that retail has exposure to these companies and these assets that you know, we saw an opportunity to give a robust offering.
And Vlad, I mean, you mentioned, you know, launching this in the U.S. as well. Is there a specific, you know, regulatory change that you need in order to get this done?
Well, for tokenization in the U.S., we do believe that the SEC has the authority to make it happen without legislation, which is interesting. And you probably saw last week, Chairman Atkins of the SEC gave an interview about tokenization. He called it a great innovation. And we agree with that. We think tokenization is perhaps the biggest innovation to come into capital markets in the past decade. So I think the U.S. shouldn't be far behind. I think the opportunity is too large to ignore, not just for retail, but also institutional. And I think they're keen. They're having tokenization roundtables at the SEC, which we've been a part of. So
how quickly can we expect
hard to
it?
predict.
Yeah.
I think the challenge with the U.S. is we already have something that works. You know, we have the traditional financial system. It's maybe not 24/7, which tokenization would allow, but it's 24/5. There's a lot of stakeholders that we have to make sure feel good about the change. I mean, we haven't even fully moved off of mainframe in the U.S. So I think it could take time, but I'd like to see the door opening for tokenization rather quickly. And I actually think our event should help accelerate that. Now that you see real products that are useful to customers with this fundamental technology, I think there's going to be more and more pressure for, you know, industry partners around the world to adopt the technology.
Vlad, thank you so much for coming on. Always a pleasure to speak to you. Vlad Tenev, their Robinhood Chief Executive Officer. Now, Jane Street, thank you. Jane Street has told employees that India's securities regulator made many erroneous or unsupported assertions about the company's trading activity in the country. Now, in an email to staff, the U.S. proprietary trading firm and market maker said it strongly rejects the Indian regulator's accusation of index manipulation. Bloomberg has approached the regulator for comment. And the French President Emmanuel Macron is due to arrive in the UK later this morning for the first state visit by a French leader since 2008. There'll be lots of pomp and ceremony, but also plenty of serious talks on the agenda. Let's get more from Bloomberg's Alex Morgan. Hi, Alex.
Good morning, Francine. Yeah, goodness me, it is a packed 3 days, a blend of sort of soft power and thorny political issues. Let's start then with the issues that will be the shadows cast over all of the pomp, the ceremony and the scenes that we'll see. Top of the agenda, and this is migration. It is a huge issue domestically for the UK government. They, of course, have the right-wing Reform Party with Nigel Farage at the helm there, chomping at the bit to get going on this issue as small boat crossings across the Channel have reached a record high in the first 6 months of this year. The UK, Keir Starmer, looking through a thaw in the relationship with France and improvements in that entente cordiale to try and amend the return arrangements to tackle some of those crossings and hopefully turn a bit of a page there. Whether we'll get an inked deal on the issue of migration, it's unclear. But then you've got security and defence. Now, the two leaders will be chairing a call of the so-called coalition of the willing. You remember that's that group of nations hastily assembled when it looked like the war in Ukraine could come to some sort of pause or stop, requiring the UK, France, Germany to step in and support the peace. And then, of course, there is also this talk of growth and investment. The 37th Franco-British Summit will also be part of the leaders' meeting, where growth and investment is, of course, going to be something talked about. And I think the mood music, Francine, if we look to the agenda, you can get a sense of the kind of the pomp, the ceremony, with King Charles leading the way, a charm offensive, a welcome at Windsor Castle, not Buckingham Palace, because of renovations taking place in London. The King, of course, himself, a Francophile, a fluent French speaker. You can imagine he'll be very much turning on the charm. And I think the emphasis you'll get from both Macron and Keir Starmer will be this sense of we've turned a page from Brexit. This is a new English, new UK French relationship. And while there are these big issues, I imagine the two leaders at their joint press conference, which will round off the 3 days, will be really looking to those positive ties. And you can see it's the first visit from a French leader, first state visit since 2008. And my word, has the world changed since then, Francine?
Yeah, it certainly has. It feels like 5 lifetimes ago. Alex Morton, some great reporting there on Macron's UK state visit. Now, President Trump says he'll ship more weapons to Ukraine to help the country defend itself. It comes after the Pentagon halted flows of some air defense missiles and artillery shells to Kyiv. Let's bring in our Russia economic editor, Greg Sullivan. Greg, good morning. So why did the U.S. halt supplies to Ukraine?
Oh, that's right. The U.S. earlier had halted supplies of air defense missiles and some artillery shells to Ukraine. The Pentagon said it needed to review its stockpiles. There was some concern over whether supplies to Kyiv could be diminishing greatly needed armaments. The Pentagon is now saying that what Ukraine needs most isn't urgently needed elsewhere. And of course, we heard from President Trump saying that he will provide weapons to Ukraine. He wasn't specific about what kind of weapons would be provided, though he did say they would be defensive in nature. Now, it's important to note that this comes against the backdrop of Trump recently talking to Putin, a call he said he was unhappy about, and Russia launching some record air barrages against Kyiv and other Ukrainian cities. They've been pounding these cities with missiles and drones, and they've been increasing civilian casualties. So some of that may have played into Trump's calculus in making the reversal of this decision here.
Greg, Bloomberg reporting that Russia has collaborated with Chinese firms to make drones. What can you tell us?
That's right. So drones have really become pretty central to this conflict on both sides. Russia has long sought to have the ability and know-how to really scale up its domestic drone production as drones become so much more important in the war. What the documents outline for us is really how some of this collaboration took place, how some of these sensitive technologies can find their way from China into Russia, and they really detail kind of from start to finish how these drones can be made and how some companies are actually trying to scale up production. In particular, there was one company, Arrowhit. The documents really showed how they used intermediaries to source some of these technologies from China, as well as deliver final products onto the battlefield, as well as some of the collaboration. Another interesting facet from these documents that Bloomberg reviewed was that a Russian delegation traveled to Harbin in 2023 and met with companies linked to Harbin Institute of Technology, which, by the way, Putin then visited in 2024. So really an interesting start to finish portrait of how Russia is trying to get these drones that it is now using to basically launch barrages on Ukrainian cities to try and wear out Ukraine and get Kyiv to capitulate to its war demands.
Greg, thanks so much. Greg Sullivan there, our Russia economy and government editor. Now, coming up, we'll discuss the outlook for leisure tourism with the chief executive of theme park and attraction giant Merlin Entertainments. That's next, and this is Bloomberg.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
It's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome back, everyone. Now, global spending in the leisure travel market is expected to triple over the next 15 years. That's according to a new report. Now, a review by Boston Consulting Group estimates that the industry will be worth some $15 trillion by 2040. Now, that growth is being driven by emerging markets. Now, for some insight, we're joined by Fiona Eastwood, the chief executive of one of the world's largest theme park and attraction companies, Merlin Entertainments. Some of its most iconic attractions include Legoland, Sea Life, Madame Tussauds, and the London Eye. Now, it's just opened Legoland Shanghai, the first Legoland in China. So, Fiona, thank you so much for joining us. And you were just in Shanghai, actually, for the opening, so it's a great time to speak to you. China's going, I guess, through a little bit of a rough spot because of consumption, because of the decline in baby borns. Why do you still think it's a good time to be invested in China?
Well, I've just come back, as you say, arrived back on Sunday. We launched our fabulous new park at the weekend. And it's fair to say China has been challenged in terms of the economy the last few years. We've operated in China for just shy of 20 years, so we are at an advantage. We know the market. We've catered to over millions of guests. In terms of the market, there are good signs in the last few months. If you take retail spending as a good gauge of consumer sentiment, that has been up in the last few months, 6.5%. I think the analysts thought it'd be about 5%. And certainly we've just had a sold-out weekend in our hotel and our tickets. So we're feeling very positive.
I mean, do you worry about pricing, or is there like, how do you make, what's the secret sauce to making it successful in China, where you also have quite a lot of competition?
Yeah, I mean, it's a very competitive market, but it's also a significantly huge market. So if you consider Legoland Shanghai, it has 55 million people living within the drive time for the theme park. And then if you consider we've also built a themed hotel, that has 250 million people living nearby because of the high-speed train links that have been built to cater for the park. So it's very positive. In terms of pricing, as we've operated in Asia, this is our third Legoland park in APAC and our biggest at launch. What we've learned from all of our research, all of the millions of guests that have visited us over the last 20 years, we've priced accordingly. At the same time, we also make sure there is a broad range of access in our pricing. So our annual passes, for example, is just the price of a 2.5-day ticket, and they can visit all year round. So again, we're seeing really good signs in terms of our sales for that as well.
If you're not overall, like, what's doing really well across the world? I know that, there are some places where tourism is really hot, others less so, but are people worried about tariffs and trade and consumer spending in general, or are they quite happy to travel less but go to theme parks?
I mean, it's a mixed picture. So we're in 20 countries around the world with 130 plus attractions. So it's always very different. And what's brilliant about Merlin, all the years we've been trading, is because we are perfectly hedged in terms of different economies and different types of incidents. We're pretty resilient. What we are seeing is the UK, Europe and APAC are pretty strong. There's some signs of slowdown in the US. However, we're very positive about the rest of the world, and we price and market accordingly.
Is there anything that surprised you? Do people book tickets a little bit later than they used to? Again, we all change our habits and kind of, travel differently to what we did pre-COVID.
We're definitely seeing differences post-COVID. People are booking much later. In some markets, we are seeing even hotels on the day being booked. But again, because of our scale and because of our much-loved brands that we work with, there's a high demand for our business in a lot of the markets.
So what are you most excited about for the next 12 months? And what are you most worried about in terms of of what you have to do to get your priorities right?
I'm really excited about launching Legoland Shanghai. It is our biggest at launch. It's our 11th Legoland park, and you're going to see much more of that from Merlin in terms of scaling our much-loved brands. We have Lego, which is the biggest toy brand in the world. We did a deal last year with Minecraft, which is the biggest gaming brand of the world, and we also have several Pepper parks around the world, and that's the biggest toy brand. So I'm really excited about the brand partnerships.
And what you have to get right, because it's not an easy environment to do business in general because of all of the unknowns. And I imagine that investing for the future is a little bit harder than it was even 12 months ago.
Yeah, to some extent. I mean, ultimately, all of our investments, because they're high capex, are made over the long term. And we're very fortunate with our shareholders, Kirkby and Blackstone, are in it for the long term. So we make long-term decisions, like, for example, Legoland Shanghai. That investment was in 2017. And whilst there's been some economic turbulence in between, we know that that's a big bet. And those are the big bets we make in all of our big markets. We're also heavily invested in major cities around the world, such as London, Singapore, Sydney, Orlando, and those are all markets that cater to families that want togetherness.
How do you look at AI? So does it replace, I know I've heard you say that it won't replace the roller coaster because the thrill of the roller coaster can never really be quite matched, but does it change how you think of rides, or does it help with queues? That's what people really want to know, the queues.
I mean, AI is fantastic. And as with every company, we're building various use cases. We've already been, our Merlin Magic Making team have been using AI in terms of rides and in terms of creativity. But it's probably got the biggest role in terms of back of house, how we become better, faster, and more pace in our decision making based on AI. But of course, we'll also be using it in park in terms of improving the guest experience around queuing and other elements as well, in making sure our ride maintenance is also driven with AI as well. So there's lots of opportunities.
I mean, does it change, for example, food offerings and things like that because it's quicker to predict? Or have you been doing it in-house anyways through algorithms and other ways? How life-changing is AI for you?
Not necessarily in terms of food and beverage, but it's more in terms of that back of house. So better predicting consumer trends, better understanding our customer base, what they're doing, making sure we've got a single customer view. And that will all be powered by AI. And like I said, make faster decision making and really power our business decisions going forward.
Your ideal customer, is it families? And again, is it different in the US or in the UK than it is in China?
Well, we're very much aligned. If you think about our parks, so the Legoland parks, that's 2 to 12-year-olds, that's about families. Why Merlin has been so resilient. At the heart of the Lego brand, it's about learning through play, which has huge importance in nearly every market, but it's predominantly 2 to 12. Our other theme parks and our other attractions, such as Madame Tussauds, slightly aged up. And so we really cater from the toddler, Peppa Pig, all the way through to young adults and grandparents in terms of sea life.
I mean, do you see a lot of Americans coming for holidays? Does that show up in the figures at Madame Tussauds?
Yeah, it does, particularly the London Eye. I mean, the London Eye is that iconic attraction that all tourists see as a big part of their visit to London, as per Madame Tussauds as well. So we see US tourism is hugely important, in particular for the UK market.
Fiona, thank you so much for joining us today. That was Fiona Eastwood, Chief Executive of Merlin Entertainments. Now, we have, of course, a lot going on today. It's not only about tariffs. There's quite a lot going on when it comes to President Trump and what he wants to do going forward. This is the picture overall for markets. So stocks seem to be holding up pretty much firmly as Donald Trump's administration's latest tariff announcements also seem to give way to a little bit of optimism that there's ample room for further negotiations. So a full roundup of the markets, also focused on everything that we're seeing on spiraling global trade war. This is a picture that we're looking at the moment, with NASDAQ futures gaining 0.3%. Up next, a Bloomberg Brief, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
How are we going to get the debt down and the deficit down if we have these big tax cuts?
Well, David, let me just say, I think the deficit is probably the most important issue today in terms of the long-term impact on the economy. And just to put this in perspective, in the first term, we had debt to GDP ratio of about 100%. And with the tax cuts and economic growth before COVID, we were growing the economy faster than we were growing the debt. So that ratio would have come down. And I think we were trying to get it down to 90 to 95. The big focus on the first term was military spending. We unfortunately had to increase non-military spending to get it through the House and Senate. But what really impacted us was COVID. And I think, as you know, firsthand, we had to spend a lot of money in COVID or we would have had a worldwide depression, not recession. I think the problem was, the first $2 trillion was well spent. The next $2 trillion we never should have spent. And then the Biden administration kept on spending. So, we have debt to GDP of close to 125% today. That's a gigantic problem. Secretary Bessent has talked about getting the deficit down from 6% to 3% of GDP, and that's got to be a major focus.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It is 5 a.m. in New York City. Good morning. I'm Lizzie Burden with your Bloomberg Brief, standing in for Danny Berger. Here's what you need to know. Open for talks. President Trump signs a wave of threatening letters to trading partners while delaying the deadline. Trade relief. Futures edge higher as Washington buys more time for negotiations. Yields rise ahead of a string of auctions this week. And Meta's hiring spree continues with Apple's top AI executive joining the firm. A very good morning to you, and it looks like the goalposts have shifted again. Yes, we had those tariff letters sent over yesterday, finally, but when you look at the levels here, they're pretty much unchanged from April the 2nd, Liberation Day. They're not as high as some of the levels that President Trump had been threatening. So this market is like, nah, we've seen this all before. We've got futures pointing higher as we head towards the Wall Street Open. And in fact, when you look at the S&P, over at Goldman, David Costa says that we could be getting to 6,900 over the next 12 months because of the Fed cut expectations. That's the second time he's raised his call in just 2 months. But of course, he says the trade risks linger. But just flipping over to your Treasury market, yesterday you had traders continuing to digest that jobs report, getting back to their desks after the holiday. Yields higher across the curve, and we've got the 10-year currently at 441. But I'm watching euro-dollar because it looks like that US-EU trade deal is just around the corner. That is lifting the currency to a 117 handle right now. But let's take a look at some of your pre-market movers. Joe Easton's here with that. Joe, what are you watching?
Morning, Lizzie. So I'm watching Tesla today. A bit of a rebound after that big drop yesterday in Elon Musk's car maker. Remember, we were down close to 8% at the low on Tesla yesterday. Coming back up today. All of this, really, this volatility driven by the spat between Musk and Trump, and also Trump's clamp down on the renewable sectors. That stock getting a bit of a reprieve today, but still down sharply on a 2-day basis. Then, speaking of renewables, we are lower once again on that sector this morning as Trump looks to potentially curtail some of the tax exemptions that had already been scaled back massively a few days ago in the big, beautiful bill. So we are seeing the likes of Sunrun declining almost 6%, First Solar down 3%, Enphase or similar amount, Solar Edge, all of those heading lower in trading today. Then I've got a downgrade for you. CNN, now this is at Morgan Stanley, an interesting one because they're talking about the AI trend potentially overdone. This stock's rallied about 70% on a 1-year basis. MS says that has gone too later for other stocks in the AI space. As usual, check out the Before the Bell opening wrap on the terminal for a summary of all this news and more, Lizzie.
Lovely stuff, Joe Easton. We'll get back to you later in the hour. We thank you. And in just moments, Morgan Stanley's James Lord's going to give us his read on the dollar's path forward. And later on in the hour, Veronica Clark of Citi will join us to discuss the tariff impact. But speaking of the dollar, it's down more than 10% this year as the trade and geopolitical uncertainties dominate the headlines. And James Lord of Morgan Stanley's weighed in. He writes, contrary to many investors, we think that the dollar's weakening trend is at the intermission, not the finale. Well, James indeed joins us now. He's head of FXEM strategy over at Morgan Stanley. Good morning to you, James. I want to continue your metaphor because it looks like we got a plot twist yesterday in the dollar weakness story. Yes, the tariff letters went out, but we saw dollar strength. It looked like a safe haven once again. Were you surprised by that?
Well, I mean, as plot twists go, I would say it was a pretty minor one. I mean, I think we've already pretty much reversed the dollar strength that we saw on the back of those headlines. But yeah, absolutely. I mean, I think that the fact that it strengthened at all was a little bit different to, I think, how markets have come to view the dollar's relationship with risk assets. I mean, when you look back at what happened on April 2nd, very different reactions. Stocks down, but the dollar also going down. This time, stocks down, but the dollar actually rallied a bit. I think there are a couple of reasons for that. I mean, first of all, when you look back at what happened in the week after April 2nd, you saw the front end of the US yield curve drop quite quickly, and the market had priced in about another 30 basis points of Fed easing through the course of the cycle. That was more than what we had seen for other central banks. So rate differentials at the front end of the curve actually moved in a weaker dollar direction. This time, you saw very little reaction at the front end of the US curve, so you didn't get that downward pressure on the dollar coming from a repricing of the Fed. And I think second of all, the technical setup now is just very different. I mean, back in early April, we saw in the aftermath of Liberation Day, we saw a lot of hedging of US assets with asset managers, pension funds, and so on, deciding to reduce the FX exposure of their US assets by FX hedging. I think, in the months since then, you've seen a substantial portion of that hedging being undertaken. It's very difficult to get very timely data, so we don't have a lot of clarity about where hedge ratios are, but we do know from our conversations with clients that they have gone up. So a lot of that flow has happened, and clearly a lot of more speculative positioning as well from a sort of hedge fund community and other asset managers that have just positioned for a weaker dollar. That technical short position is there in the market. And I think when you get things that when investors and traders are getting things that they don't expect, and you see risk aversion coming through, the first instinct is to reduce your risk. And in the technical setup of the market yesterday, that meant buying back some dollars. But as I said, Lizzie, it was a very small reaction. We've already unwound it, and I think through the course of the year, actually, the dollar will continue to decline.
Okay, so it was a blip maybe, but of course we did see on the flip side EM currencies tumbling off the back of the tariff news. And I just wonder what's more important here. Is it the fact that the tariff threats have been issued, or is it the fact that the deadline's been delayed?
Well, I think the muted reaction overall in markets, whether you're looking at G10 markets or EM, suggests that people are, expecting more negotiations to happen. And we know that the tariff announcements that have been made, that they could come down, the deadlines could get extended again. So I think overall, that explains the muted reaction. But I think, one of the views that we've had on the EM side is that whilst we're happy to take some EM exposure, we think a weaker dollar will benefit EM. The uncertainty that's generated by all of these trade negotiations, the deadlines changing, the tariffs going up and down, it does not help corporate confidence at all. And our economics team is expecting global growth to slow down this year as you get investment decisions delayed, CapEx decisions put on hold. And the global economy just suffers as a result of that. That typically is not a great environment for emerging markets, not a great environment for commodity currencies. And so, whilst we do think EM, particularly the EMs that have solid bottom-up kind of reform stories, and there are quite a few, we think those markets can do well, but overall, the global growth backdrop is not an environment which you'd typically expect EM to be doing that well in.
But if you see global growth slowing, let's just turn to the euro, because you see the euro dollar at 125 by mid-2026. What sort of economic conditions on the European continent would be needed to unlock that kind of level?
Well, I mean, a lot of it's been driven by the dollar. You know, the slowdown in the US. I mean, we've moved from a period where US growth was, you know, substantially outperforming the Eurozone to what we expect to be something more in line with the Eurozone for this year and next year. The Fed, we think, will ultimately cut down to 2.5%. That's not priced. All of the uncertainty that's been generated by US policies, that's something that will weigh on the dollar. So it's to a large extent a US view, a dollar view that's pushing euro dollar up, and that will weigh on European growth. I mean, our equity strategy team is expecting to see, as we're getting into earnings season now, it'll be really interesting to see how European corporates are guiding in terms of the pass-through from FX, like will we see negative earnings guidance and so on. And absolutely, it will put downward pressure on Eurozone inflation and put Eurozone growth under some downward pressure.
Yeah.
No question about it. So it might end up resulting in more ECB rate cuts, for example, but that would come in response to currency strength.
Yeah.
And it's not something that would push the euro down. It just might moderate how far it goes.
But, you know, the ECB is still on the receiving end of this, even if it is a dollar story. And you've had the likes of Luis de Guindos at the ECB warning that, you know, past 120, that's problematic for the Eurozone. He says that it's not just about the level, it's also about the speed of ascent. And I just wonder, in the second half of the year, does the euro's pace of gains slow?
Yeah, I mean, I think that's the implication of our forecast. I mean, actually, for the end of this year, we've got a 120 target. So, I mean, that would suggest that the pace of euro dollar upside is going to really moderate over the second half of the year. I mean, I think the risk to 120 being hit might be slightly earlier than the end of the year, but still, I think the pace can slow. I mean, we also think the market might be overpricing a bit the chance of the Fed cutting twice this year. It'll be interesting to see how the next inflation print and the FOMC minutes this week go. But I mean, inflation's next week, but FOMC minutes are from tomorrow. You know, that any repricing at the front end of the US curve as well could kind of slow the pace a little bit. So yeah, we could be moving into a slightly different environment, and maybe that's something that would the ECB would be more comfortable with, a slower pace. Absolutely.
All right, James, thanks so much for starting your day with us. James Lord of Morgan Stanley. I'll have to catch you in London next time. Well, now to some other top stories trending on the terminal this morning. Apple's top executive in charge of AI models is leaving for Meta. To secure the distinguished engineer, Meta offered a package worth tens of millions of dollars per year. And CEO Mark Zuckerberg has made the AI the top priority at the company as it races to keep pace with rivals like OpenAI and Google. Elsewhere, Porsche is warning of a tough road ahead for sales this year after global deliveries fell 6% in the first half. This was an improvement, though, on the sharper decline recorded in the first quarter. European luxury car makers are losing momentum in the US and continue to fall behind in China, where local brands are taking over. And the Israeli Prime Minister Benjamin Netanyahu says that he's nominated President Trump for the Nobel Peace Prize. In his letter to the committee, Netanyahu said Trump's efforts had, quote, brought about dramatic change and created new opportunities to expand the circle of peace and normalization. Well, coming up on the programme, President Trump leaves the door open for talks while threatening trading partners with higher tariffs.
Say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
That's next. This is Bloomberg.
of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
The constant change of position and the delay of the dates at which the tariffs are supposed to kick in, I think just confirms that a tariff war benefits no one. It is really a lose-lose proposition. And from the European Union, we have every interest in finding a good outcome that will continue to preserve free trade.
No one is it a trade war. That's according to the European Investment Bank President Nadia Calvino. But it seems the president wasn't listening. He inked that wave of letters threatening key trading partners with high tariff rates again. That's as he signed this executive order to delay the deadline to August 1st, leaving the door open to negotiations. Our team coverage starts right now. Bloomberg's Brendan Murray, who leads our global trade coverage, and Stephen Carroll, who anchors our European radio coverage out of Brussels, join me now. So nice to see you both. And Brendan, I want to start with you, because are these letters from yesterday actually a relief, given that, you know, the deadline's been pushed back to August 1st and the levels are mostly unchanged from August 2nd? They're certainly not as high as threatened.
Yeah, exactly. A lot of countries would be relieved that they've gotten themselves another 3 weeks. But the 90-day reprieve was always an optimistic one to begin with. Trade deals are difficult, to get complicated, particularly toward the end. And the Trump administration is essentially conceding that number, that 90-day period, was just was not enough to get done what they hoped to get done. So it will another 3 weeks lead to the kind of deal closing that they expect. We'll have to wait and see. But the Trump administration officials who we're reporting on say that they think some are very close and that they can get over the finish line here before August 1st.
Well, yeah, Brendan, in those 3 weeks, Japan and South Korea have got to, according to the president, open their markets and manufacture more in the US, or at least agree to, or they're going to face 25% tariffs from August the 1st. When you look at the domestic politics in those countries, does it look like actually they can bend to these demands?
Yeah, exactly. South Korea's got a new government in place for just over a month. Japan has its upper house elections in a couple of weeks, so there's some difficulty there trying to give up too much before voters go to the polls. So there seems to be some hope from both Korea and Japan that they will still continue to negotiate. This is not the end for them. They will send their teams to Washington in the weeks ahead to try to pull this off. But 3 weeks is not much time. And of course, the Trump administration is handling dozens of other countries' requests for some relief from those reciprocal tariffs that President Trump declared on April 2nd would basically be easy to pull off. But I think what they're finding out is that's easier said than done.
Stephen, let me bring you in here, because notably there was no letter to Brussels yesterday, and we hear that the two sides are inching towards a deal. Eurodollar's taken it as a positive. What are the remaining sticking points?
Well, it's a question, I think, of what aren't the remaining sticking points, because you would hear from the Commission spokespeople yesterday talking about us being near the beginning of the end when it comes to these negotiations. But what they're talking about is, again, only a framework deal that's being viewed as a sort of an interim arrangement here to get the EU past that 1st of August level without tariffs going up. They're aiming for that 10% level, as we've heard, although the key question now is over the carve-outs. Can the EU get the exemptions it wants for aircrafts, aircraft parts, and for wine and spirits? That's the key nut of the negotiations for now. The sticking point, though, I would watch very carefully is the car industry here. We know that several of the big car makers and their capitals representing them had been looking for a kind of a quota system, whereas companies that manufacture more cars in the United States would then be given a certain quota of tax-free exports of cars, or tariff-free, I should say, exports of cars coming from the EU to the US. So that's a key area we don't have hints yet that there's an agreement. What's under negotiation, though, this arrangement, interim deal, whatever you want to call it, is something that there should be some talk to about non-tariff barriers. So we're watching very closely here to see if the EU is going to add any easing on its digital rules, for example, and whether that could be something there's progress on. No sign of any movement on that front for the moment, but the EU is still very optimistic of getting a deal. Finance ministers are meeting here in Brussels this morning. They were getting an update from the Commission before their meeting started, and they were making positive noises going into that meeting about the prospects for a deal to be reached.
Well, yeah, you mentioned auto tariffs. Is there a sense, Stephen, in Brussels that they want to wait and see how other countries are treated before they sign up to a deal?
I think everyone's watching everyone else in these negotiations, Lizzie, but the European Union knows that it has the upper hand in a lot of ways because it is a very large trading bloc. It is a massive trading relationship between the EU and the United States. So they have more latitude to be able to take a tougher stance. We know they've identified 21 billion euros worth of goods they could hit with retaliatory tariffs, and there's going to be a list of 95 billion more that they could also bring up if things don't go well. They're preparing for all outcomes. So a question, I suppose, as to whether or not anyone else's deal is going to be applicable to a trading bloc as big as the European Union and as complex as the European Union. We'll still have to wait and see how the last, I suppose, minutes or days of those talks work out before we see how different the deal for the EU might be to some of those other ones we've seen.
Well, yeah, of course, they've got an eye on Beijing. And Brendan, the US Treasury Secretary Scott Bessent says that he expects to meet his Chinese counterpart in the coming weeks. What are the likely next steps here? Because, of course, they've got to build on what they've already achieved in Geneva and in London.
Yeah, exactly. Let's not forget that there's another deadline in August, and that's August 12th, when theoretically the U.S.'s 145% tariffs on China could spring back higher if China hasn't lived up to its end of that deal. So what I think we hear from Secretary Bessent is that he's going to go take a check on how that compliance is going, and to try to work out some arrangement where the world's two largest economies kind of lower the temperature even further in the months ahead. So that's really going to be a key question for the U.S.-China relationship going forward. Of course, the stakes are very high when it comes to the trading relationship of those two countries,
including for the likes of the UK. Brenda Marie, Stephen Carroll, so lovely to have your team coverage with us this morning. Thank you both. Now, coming up on the programme, a look at what else is making headlines around the world, including President Trump making a reversal and giving more weapons to Ukraine. This is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Time now for our front page news. A look at what's making headlines around the world. First up, on the New York Times, the death toll from a devastating flood in central Texas has risen past 100. That number includes 27 campers and counselors at Camp Mystic, an all-girls Christian summer camp from which 10 campers and a 19-year-old counselor remain missing. Even as they continued to project hope, officials in Texas on Monday began suggesting that their efforts were transitioning from rescuing to recovering. Next up, on the Wall Street Journal, President Trump said he'd ship more weapons to Ukraine, marking an apparent reversal after the Pentagon halted flows of some air defense missiles and artillery shells to the country. The president lamented the thousands of people who've been killed and said he wasn't happy with President Putin for keeping up attacks. And the Financial Times reports that Shein privately filed a draft prospectus with Hong Kong's exchange last week. The online retailer filed for a London IPO about 18 months ago, but has been unable to secure regulatory approval. It has filed in Hong Kong in part to try to pressure the UK regulator into compromising on its risk disclosure requirements and keep alive what could be the biggest IPO on the London market in years. Coming up, we're going to speak to Citi's Veronica Clark on the economic impact of the proposed tariffs. That's next. This is Bloomberg.
Was it easy to get the pandas to come back to Washington, D.C.? Did the Chinese say, we have some extra pandas, we don't know what to do with them, we're going to give them to you?
Well, it was a little more difficult than that. It probably took us, it was about over the course of a year where we had conversations with our colleagues in China, and we were able to get pandas here very quickly. I think it's a testament to the relationship we've built over decades, to the conservation success that we've had, here with our pandas and our panda program. And so it was a lot of conversations, but I think we always knew in the end that we did want pandas at the National Zoo.
How many pandas are there in the entire world?
So this is incredible because this is all due to this panda program, and this is so important. So when we started with giant pandas 50 years ago, there were fewer than 1,000 pandas in the world, right? We're talking in the wild and zoos, fewer than 1,000. And decades later, there are close to 2,000 pandas in the wild now. Actually, I think a little over 1,800. There are over 700 pandas in breeding centers. So as part of this program, we have tripled the number of pandas on the planet.
But still a small number of pandas.
Because of this program, there are more pandas on the planet, more quality panda habitat in the wild, and pandas have gone from being endangered to being vulnerable.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Lizzie Burden with your Bloomberg Brief in for Danny Berger. Here's what you need to know. Open for talks. President Trump signs a wave of threatening letters to trading partners while delaying the deadline. Trade relief. Futures edge higher as Washington buys more time for negotiations. Yields rise ahead of a string of auctions this week. And Meta's hiring spree continues with Apple's top AI executive joining the firm. So the door is still ajar. We're looking at futures pointing higher after the president sent out his tariff letters yesterday because, look, August the 1st is the new July 9th when it comes to the deadline for talks. And while these tariff rates align with Liberation Day on April 2nd, they're not at the upper end of Donald Trump's trade threats. So the market seems to be like, meh, we've heard it all before. And we're looking at positivity across the screen there. Indeed, Goldman's David Costans raised his target for the S&P again to 6,900 by the next 12 months. It's the second time he's raised it in less than 2 months on the expectation of Fed cuts, though he admits that trade remains a risk. Now, flip over to your Treasury market. You've got the 10-year there at 441. You've had traders continuing to digest this jobs data because they're just getting back to their desks after the holiday weekend, of course. And then keep an eye on euro dollar. We're at 117, higher today because of all of these hopes of a US-EU deal. But let's get to some of the stocks we're watching this morning. Joe Easton's back with that. Joe, what's catching your eye?
Hey, Lizzie. So Tesla catching my eye today, getting a bit of a rebound after that big drop down we saw in the car maker yesterday. We were down around 8% at the low, 7% at the close, but Tesla up 1.3% today. A lot of the focus remains on the fallout between Trump and Musk, whether there is going to be a tighter clamp down potentially on Tesla. We have seen them cutting back potentially on some of their tax credits as well. So that was the reason yesterday, but a bit of a reprieve finally today. Then over in renewable energy, weakness once again. Trump is looking to rein in some of the tax credits for wind and solar as well, and that is hitting a number of stocks today. We're seeing Sunrun down close to 6%, Enphase falling 4% at the moment, and Solar Edge as well, extending that drop in the pre-market, down more than 6% on that one. Keep an eye on renewables today. Then finally, a broker move for Sienna over in the telecom space. Morgan Stanley going underweight on this one because the AI boost has gone too far. That stock has rallied around 70% over the past year, and MS thinks that that is too big of a move. So we're seeing that stock declining 4%. Keep an eye on Sienna alongside Tesla and renewables in pre-market trading today, Lizzie.
Joe, many thanks. We appreciate it. Now, we have a new deadline, August 1st, for tariffs to kick in on goods from key trading partners. That's as President Trump threatens nations with higher rates. Now, ahead of the announcement, Citi's Veronica Clark wrote, quote, The average effective tariff rate may rise somewhat, but in our base case, we expect that it'll stay around the current 15%. And I'm pleased to say that Veronica joins us now. Veronica, we've got some more news as of yesterday. The letters went out. We don't have many deals so far, though, only the UK and Vietnam.
Right.
Do you stand by 15%?
Yeah, that's kind of what we're looking at so far. We tried to run the numbers roughly based on those letters that we got yesterday. The trading partners that got new tariffs yesterday, of course, to take effect in August, they're still relatively small, especially when you consider that a lot of the sector-level goods that might be facing other tariffs are carved out for now. So yeah, I think that 15% still somewhat stands, but maybe the risk is that it could be a bit higher. I think it was a bit surprising to see a lot of the announcements yesterday. You know, these tariff rates are not that much different than what we heard on April 2nd.
Okay, so maybe a surprise to the upside as things pan out. When we think about the economic impact and when we're going to see it, of course, this time next week we'll get US CPI. Is that still too soon to see the inflationary impact?
I think it's probably still too soon. This is, data for the month of June. Maybe we're starting to see it in some components like car prices. Anecdotally, that seems like maybe some of the first sectors where we would see it. But I think it probably will take maybe more, later in the summer, early fall, especially with all the delays and the tariff uncertainty. I think businesses are going to try to hold off on raising prices as long as they can. This does not seem like a consumer that's particularly strong, and so you don't want to raise prices if you don't have to.
And how much is it actually because, you've had all of this rerouting of supply chains since COVID? How much is that providing a buffer?
Yeah, it probably is doing some of that. Of course, we had a lot of, heavy reliance on, Chinese production pre-COVID, pre-Trump 1.0 tariffs, and those two events probably had shifted some production away from China. But then we're looking at, still pretty large countries, large tariffs on countries like Vietnam or Cambodia, maybe where that production shifted. So if those tariffs do come into effect, then it's harder to avoid.
So we'd usually get you in after the jobs report on a Friday, but of course it was July 4th. But the effects are still panning out in the market, right? We're still digesting those effects.
Yeah.
When we look back at it, and as we look ahead to the FOMC minutes this week, do you still see September? Is September when the cuts could start?
I think so. These minutes, I think, will sound a bit stale. Of course, we have had that stronger jobs data, although it does look a little bit out of line with other labor market data we've seen. We've seen continuing jobless claims rising. That's not the best sign for hiring trends. But on the surface, the numbers were still strong. But it was an interesting shift. After that June FOMC meeting, which was very neutral, we heard Fed officials really after that meeting turning a bit more dovish, talking about the potential for July, which looks very unlikely now. But I think it was really after that meeting that we heard this more dovish shift towards September. And I think the data will come in line enough that they can still be cutting in September.
Okay, interesting. Dovish and divided, I might add.
Yeah, they were very divided at that June meeting. This group of people who don't want to cut at all, and then group of people who maybe want to cut multiple times. So it could be some interesting minutes, but it's really the data the next couple months that will determine that September cut.
Well, yeah, it's interesting. Under the hood of the jobs market, you've been flagging the participation rates drop, and I just wonder how much slower immigration under Donald Trump is actually masking the weakness in the labor market.
Yeah, that could be some of it. It's really hard in any given month, in the details of the unemployment rate to know what is the exact driver. It was interesting, though, in this June data, yes, we had the decline in the participation rate again. It's been a really large decline the last couple months. But in June specifically, it didn't look so much like immigration. It actually looked like people getting discouraged in leaving the labor market. There was the largest jump in people being discouraged in leaving the labor market on record, essentially. That is just people giving up after looking for work for a while. And yeah, if you're not looking for work, you're not counted as unemployed, but that's not a positive labor market story.
So people aren't looking for jobs, but because we also get the jobless claims numbers, and at the moment the narrative seems to be that companies aren't hiring or firing.
Yes.
How much is that because of the tariff uncertainty?
Yeah, that could certainly be part of it. Tariff uncertainty, tariff costs themselves. You're trying to cut labor costs, and so you're not hiring as much. But that low hiring, low firing dynamic has really defined the labor market for the last couple years. And yes, it hasn't changed. Maybe hiring has gotten a bit worse. We would theoretically be on the lookout for a change in that firing dynamic at some point. If businesses are trying to cut labor costs, that layoff is the next natural step.
But how much is it also about AI? That you've got AI doing the jobs that humans used to do?
There certainly could be some of that also. It's really impossible to put a number to something like that. We don't know how many people would have been hired in the counter scenario. But yeah, maybe that could be part of why younger workers, new graduates are struggling to find work too.
Well, let's hope that the AI isn't coming for our jobs anytime soon. Veronica Clark, lovely to see you. That's Citi's Veronica Clark. Now, to some other top stories trending on the terminal this morning. German exports sank more than expected in May as the value of shipments to the US plunged to their lowest level in more than 3 years. Imports sank 3.8%, including a more than 10% drop in sales from the US. Germany is, of course, seen as particularly vulnerable to US tariffs and is still currently subject to sectoral levies on items like cars. Speaking of cars, Porsche is warning of a tough road ahead for its sales this year after global deliveries fell 6% in the first half. This was an improvement, though, on the sharper decline recorded in the first quarter. European luxury car makers are losing momentum in the US and they continue to fall behind in China, where local brands are taking over. And Samsung's profit fell for the first time since 2023, with a 56% plummet in operating income for the June quarter. The firm blamed the sharp decline on inventory write-downs following US curbs on Chinese-bound AI chips. The disappointing results underscore how South Korea's largest company has ceded leadership in the AI market in the post-ChatGPT infrastructure boom. Well, that's what's trending on the terminal. Coming up on the programme, President Trump issues fresh demands ahead of his tariff deadline, which may not be a deadline after all. That's next. This is Bloomberg.
I would say firm, but not 100% firm. If they call up and they say, would like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
presidente da República de país do tamanho dos Estados Unidos,
a president of a country the size of the United States, to go around threatening the world on the internet. It is not right. He needs to understand that the world has changed. You know, no, we don't want an emperor. We are sovereign nations. If he thinks he can impose tariffs on countries, countries also have the right to do the same.
Out of Rio, Brazilian President Lula da Silva there criticizing President Trump's tariff maneuvers and insisting that the rest of the world doesn't want an emperor. Trump, meanwhile, is balancing his art of the deal approach with his America First principles, having unveiled a wave of letters threatening higher rates on US trading partners that haven't cut a deal with Washington yet. For more, I'm joined by Bloomberg's Brussels Bureau Chief Suzanne Lynch. Morning, Suzanne. Just tell us, the tariff letters went out yesterday. We're told more are in the mail, but the deadline's been extended. So is this an escalation or is it a de-escalation? Dare I ask, has the president chickened out again?
Well, what he's certainly done is move the goalposts. So we're now faced with a new deadline, this August the 1st deadline. The president signed an executive order yesterday moving that 9th of July deadline to August 1st. So in one sense, it's buying all sides time to try and hammer out agreements. But there's a lot of concern, nervousness here in Europe about what this means. Now, the EU, for example, is still hoping to clinch some kind of a broad framework agreement by the end of this week. Then we'll continue negotiating until August the 1st with the hope of getting something else. I mean, at the moment, the EU has indicated it would be happy with a 10% tariff. However, there are also a number of tariffs, sectoral tariffs, on areas like autos, steel and aluminum. The United States president has threatened tariffs on pharma. These are all big industries and export industries for Europe. So, I mean, I think what they're going to want here at some of these trading partners is some deal on those sectoral tariffs as well as an agreement on a kind of 10% reciprocal levy.
And meanwhile, Suzanne, Donald Trump's been nominated for a Nobel Peace Prize by the Israeli Prime Minister Benjamin Netanyahu, of course, his dinner date at the White House last night, and for whom, it really has to be said, the International Criminal Court has arrested this arrest warrant for the war crimes in Gaza. But Suzanne, with peace in focus, have they made any progress on a ceasefire in Gaza?
Well, it doesn't look like they have. I mean, there were a lot of expectations yesterday about this Netanyahu visit to Washington, and we saw that kind of provocative statement to some people, Netanyahu, nominating Trump for the Nobel Prize. Obviously, the situation in Gaza continues, tens of thousands of deaths, and, there are a lot of countries around the world here in Europe, again, who are concerned about that, as well as strong support for Israel and its right to defend itself. So I think what's happened is, and what I think a fear of a lot of people around the world when it comes to Donald Trump, be it on trade or foreign policy, that his attention can slip from one to the other. So over the last while, obviously with the situation in Iran a couple of weeks ago, there was a sense that the attention was going off what's happening in Gaza. So there will be kind of welcome relief for some people that at least the focus is returning to what's happening there in Gaza now that the Iranian situation for the moment has subsided. But also with Ukraine, it can flip-flop. At one point, the US is extremely engaged, it seems, in Ukraine policy. At other times, that changes. So that's something I think other leaders are factoring in when it comes to Donald Trump's leadership style.
Well, yeah, on Ukraine, Trump says he's sending more weapons to Kyiv. It's a pivot for the president. He's explicitly backing Zelensky over Putin. But, Suzanne, it feels like we've been here before. How significant is this?
Yes, absolutely. Just as I was saying, there is a lot of flip-flopping on this and shifting of attention by Donald Trump. But look, there's no doubt about it. This will be welcomed by the government in Kyiv. This pledge by Donald Trump yesterday to send more weapons to Ukraine to help the country defend itself. It's becoming increasingly clear that Donald Trump is getting frustrated with Vladimir Putin. Obviously, there's very little to show in terms of a peace deal between Russia and Ukraine, despite Donald Trump's attempts to bring about peace. So it's interesting now if Donald Trump kind of refocuses on this issue, but it's undoubtedly very, very good news for Zelensky and the government in Ukraine.
All right, Suzanne Lynch, thanks for staying across all those developments for us. We'll have to have you back on. Now, talking to let's turn to tech now, where Meta has poached Apple's top AI executive, Ruoming Pang, in its latest hiring spree for top talent in the AI space. For more, let's bring in Matt Bloxham of Bloomberg Intelligence. Matt, how significant a departure is this?
Yeah, I think it is pretty significant, but perhaps not that surprising, because if you look at what Apple's been doing with its AI strategy recently, the group that Pang runs, their own foundation models group, has been largely sidelined as they try to kind of figure out what their right AI strategy is, and yet it's been kind of fairly well known for a while now that Apple's been considering buying in AI platforms more significantly to kind of build out its platform and in particular redesign its Siri project. So I think morale perhaps in this group has been a bit low, and perhaps some of them feeling like their mission, which is maybe to get more into Apple, but artificial general intelligence is perhaps not something that aligns so much with Apple anymore, and are being tempted by these big offers from Meta.
Well, yeah, it wasn't long ago that OpenAI's Sam Altman was laughing at Meta for dangling these 9-figure bonuses at his staff to poach them. Does it show that actually Mark Zuckerberg's strategy is working and that OpenAI and Anthropic should be worried?
Yeah, I mean, I guess, when you're prepared to kind of get the checkbook out and pay people tens of millions of dollars, inevitably, I think you're going to have a kind of high success rate. I mean, it's interesting, recent comments that have come to light from Sam Altman, suggest that he's not overly worried about these kind of poachers, and that actually he suggested that Meta's had to go some way down their list of priorities to get people, and that actually the people that Sam Altman wanted to retain, he's been successful in doing so. But clearly this is impacting them. I think in those same communications internally, Sam Altman was suggesting that they are having a rethink about compensation structure for the whole of their AI research team. So suggesting perhaps there is going to be a pay bump for these people, and also suggesting that there's a huge amount more upside in the OpenAI share price than there is in Meta. So clearly the message is landing that perhaps compensation needs to change for this caliber of AI engineer.
Matt, fantastic analysis. Matt Bloxham of Bloomberg Intelligence there, we thank you. Well, turning to Wall Street now, finance is an industry that is dominated by men, but women are rising and controlling more wealth globally. In the latest episode of Bullish, Bloomberg's Shonali Basak spoke with a number of leaders, including Citigroup's Jane Fraser, on what's changing with more women in top positions. Take a listen.
Citigroup at this juncture moves $4 trillion a day. $5 trillion. That's larger than...
growing.
It's larger than the GDP of France.
Yes.
That you move daily. What kind of weight do you feel on your shoulders in the morning?
I think the same as any CEO. You have to wake up every morning somewhat paranoid, feeling that urgency, a bit of excitement about what you need to do, but I think a healthy amount of pressure.
I feel like I've really tried, and as long as I've known you, to not ask you about what it's like to be a woman. I've very intentionally tried to not make that a part of the conversation, but I feel like it's now come the time to ask. Why is this something that is not addressed more loudly in this industry, that there's only one woman to lead a major U.S. bank?
It is a little surprising. I think there is a good generation coming through of really super talented women. But we've also got to recognize that there are some biases in the system, unconscious or conscious, and it's important that there's more of us that are breaking through and getting this into being business as usual rather than business unusual.
Does it ever feel frustrating to you to have to be vocal about the issue or to be the face of the issue? No one ever asked David Solomon about what it's like to be a man.
It gets frustrating when someone asks you about certain questions they wouldn't ask a guy, but for us it's about how do we try and provide opportunities for everybody along the way, make it a win-win, because I think we're dead in the water if it's a zero-sum game. If we weren't competing for the best female talent, I would be cutting the bank off from 50% of the workforce and really putting us at a competitive disadvantage. advantage. Diversity is harder work, but it more than pays for itself. My frustration is when people don't believe in the business case because it's so blindingly obvious to me.
Citi's Jane Fraser speaking to Bloomberg's Shonali Basak there, and you can watch the full episode of Bullish with Shonali Basak today at 6 p.m. New York time on Bloomberg Television, or stream at 8 p.m. on Bloomberg Originals. Coming up on the programme, we're going to get you set up for your trading day with Treasury auctions on deck. That's next. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute news whenever and wherever it happens, I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Now a look at what's ahead today. Boeing's second quarter delivery tally expected later on today, and at 1 p.m. Eastern, the Treasury is auctioning $58 billion of three-year notes. And media moguls, billionaires, and some of the biggest names in sports, tech, business, and finance are in Sun Valley for Allen & Co.'s annual conference kicking off later today. Let's check out your micro movers. We've got Tesla here bouncing back after closing down almost 7%. Capital One as well, looking to extend its longest winning streak since 2002, upgraded to buy by TD Cowen. And we have Bank of America as well, cut to hold by HSBC. Analyst Saul Martinez setting a price target of $51 for that stock. Let's just also look at your macro movers. I've got euro-dollar in focus because of all of these hopes of a US-EU trade deal. But that's it for your Bloomberg Brief. Surveillance is coming up next. This is Bloomberg.
break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question. I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Francine Lacroix, the ECB Forum in Central Portugal, and this is Bloomberg.
The administration is looking for that last bit of pressure to get these deals where they want them to be.
This is a perpetual negotiation that we'll continue to see unfold.
This is President Trump at his best, bringing the pressure and supporting his negotiators.
The market is trying to operate like this is going to be a nothing burger, but we are seeing tariff rates go up.
As the days and weeks accumulate, we're going to get greater certainty around what the trade policy posture is going to be.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, the trade deadline slides.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders, there will be additional letters in the coming days.
President Trump's new tariff threats look just like the old tariff threats. As the European Union rushes to put together a deal before the new deadline, Secretary Besson is preparing to meet with China for another round of talks. Similar tariffs, very different price action.
This is a market that has the picture. This is a negotiation. It's escalate to de-escalate. There's sort of a fool me once, shame on you. Fool me twice, shame on me, because this is a market that has seen this story before. And each deadline becomes another delay for this perpetual policy of uncertainty. And that is the key question that I have. How do companies and how do investors adapt to that type of environment?
I totally agree with you. I think two big disappointments for a lot of us. One, July 9th is not going to be a clearing event. This is going to continue. And two, if you were hoping for cuts from the Federal Reserve, this makes it harder for this Federal Reserve to cut interest rates.
Absolutely. What we've heard from Jay Powell time and time again is we don't know the tariff rates. There's a lot of uncertainty. So it's making us basically say frozen in place when it comes to policy. Well, guess what? How difficult is September going to be for them to potentially cut, which a lot of people were excited about. If we're not going to get the tariff rates at this moment, we think August 1st. And if you see April 2nd become July 9th, July 9th become August 1st, who's to say that August 1st also might not slip?
For the threats to be credible, you have to believe there could be some follow-through. And based on the price action of this morning and yesterday, it's difficult to believe that a lot of people think there's going to be follow-through.
A note from Citigroup coming out. We still expect a deal with South Korea. South Korea saying we view this as a negotiation and we'll be at the table. You've got Japan saying we're not going to take a bad deal. You have a European Union about to maybe make a deal in the next 48 hours, whatever that means. And then the details, of course, have to get worked out. There's a key question here about what the final outcome looks like and whether we have adjusted to this idea of a base tariff rate that is materially higher to pay for the deficit as sort of a policy, not necessarily some sort of negotiation.
Also, the president's rhetoric last night was very wishy-washy. quote, I would say firm, but not 100% firm. If they call up and say we'd like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now. If you want to play ball, you have to. This is what you have to pay. Right now, with these 14 countries, which basically, essentially, the tariff rates did not change, just the dates, he is in negotiating mode. I'm waiting for the other deals to potentially drop. With these countries like India, like the European Union, like Switzerland, that we have seen the United States deeply engaged at the negotiating table.
So far, not much change in the equity market, at least this morning. Unchanged on the S&P 500. Lots to get through this hour. Coming up on the program, we'll catch up with Ed Yardeni of Yardeni Research as stocks look to bounce back. The former NEC Deputy Director, Everett Eisenstadt, as President Trump buys time. And Kelsey Barrow of JP Morgan on the odds of a September Fed rate cut. We begin this hour with stocks little changed as traders face down the latest tariff threats. Ed Yardeni of Yardeni Research is optimistic, writing, we tend to be perma bulls because there are so many more perma bears. We focus on the positives and frequently find them to be more compelling than the negatives. Ed joins us now for more. Ed, welcome to the program, sir. Let's talk about these tariffs first up. The tariffs themselves and the threats look very similar to what we heard on April 2nd, right, but the price action is so different, Ed. What explains that?
Well, Liberation 2 is, been there, done that. That's really what's going on here, is the market figures this, as you folks said, this is, the art of the deal. It's negotiations. Let's not forget that Trump's background is commercial real estate and residential real estate in New York City, and they do a lot of negotiating there between other developers and politicians and labor unions. And they scream and they shout, but all that happens, all that bullying and negotiating occurs behind closed doors. Trump has taken this to another level and to a global level of negotiating publicly with leaders around the world on trade. So it's not a pretty thing to watch, but I think the markets have figured out that this is going to get resolved in the next few months. It has to be, because otherwise Trump's going to really risk losing the midterm elections for the Republican Party, and that's not going to be good.
What if it doesn't, Ed? What if it isn't resolved? How do you think markets handle an extended period of ambiguity? And what would you expect corporations to tell us in the upcoming earnings season?
Well, I think, first of all, when it comes to all this impact on the United States, so far it's been remarkable. The resilience of the economy has been absolutely remarkable. I've been in the resilient camp, and I'm in awe at how well the economy is hanging in there, how well consumer spending has been hanging in there. And I'm also in awe about inflation. Inflation really hasn't picked up. Some of the indicators for July suggest that it's actually going to be pretty close to zero during that month. It's a little early in the month, but there is sort of a nowcast for that. So all in all, I think the U.S. stock market is doing what it's supposed to do. It's supposed to take the long view, and the long view is still quite optimistic, I think, with the technology revolution we're in, the digital revolution we're in, and likely to continue to have very positive impacts on the U.S. economy and productivity.
For a perma bull, your recent note was pretty bearish, and it really focused in on the labor market and the fact that private industry payrolls rose only 74,000, which was the lowest in your data going back to 2004. And this points to something happening under the hood that isn't the sort of equilibrium that can keep on going for a longer period of time. Why do you stay bullish, even with that factor?
Well, to maintain my credibility, I do make sure to constantly write about what the bears are saying. And I was actually a little surprised that there wasn't more bearishness for the economy anyways, and the stock market, about the employment numbers that came out on Thursday. And they were weak. When you take out government employment, and a lot of that was education employment, maybe we're hiring a lot of teachers and getting them ready for the new school year. Maybe the schools have been overwhelmed with kids of migrant workers, and so they've had to load up. So maybe that's a real number. But take out government employment, and we're up only a little over 70,000 in non-farm payrolls. So I did point all that out, but then I put a positive spin on it and concluded, this is the economy has been stress tested by tariff ban, by all this tariff turmoil that we've had. And yet it's passing the tests. The banks have passed the tests. And so, you know, I kind of stick with the data, and the data on balance, I think, suggests that we probably will see some better employment numbers and a better economic growth in the second half of the year.
Just the counterpoint to this, and I can already feel people rolling their eyes, it's sort of bearish counterpoint. There is a fear that the market isn't responding to bearish news, that there isn't some sort of sell-off, that there isn't a response function because people have been trained not to be bearish, because the bulls have won out again and again, and people just keep leaning on all the liquidity in the market, but a lot of that liquidity is going to have to go to financing some of the fiscal deficit around the world of developed markets. How much does that factor in? How much do you start to watch that and say, hold on a second, something could be brewing here?
Well, you know, you can look at the fundamentals. You can, I guess, put together a list of everything that's bearish, that should take the stock market down. And then you can also look at the stock market and say, why isn't it going down? And I think first quarter earnings were much better than expected. Second quarter earnings, it's a layup. They're going to be better than expected because expectations are so low. And so I think that's going to be quite good. And then we are seeing that the president's tax bill was passed. It's an extension of the tax cut, which is bullish for the economy. In addition, from what I understand, if you want to build a data center, you can build it and depreciate the whole thing, expense the whole thing in the first year. I think I got that right, but I'm still checking that out. But I think, in other words, there's a lot in that bill that is in fact quite stimulative. The president has in fact brought a lot of money committed to onshoring in the United States. There's a lot of positives going on.
Ed, when it comes to what's going on in the financial markets, Liz Ann Saunders of Charles Schwab contemplates this in the Financial Times. On top of a Trump put, she says maybe there's this potential for a Trump call. Do you think that means that we potentially get a more aggressive White House when it comes to policy?
Well, I think certainly the Treasury seems to be on the verge of financing more of the debt with Treasury bills, which I think is why the bond market yield hasn't gone straight up. It's been going up somewhat here, and I think it's still consistent with my view that the bond yield should be trading around 4.5% through the end of the year. So I really don't have a problem with this backup in bond yields the past couple of days. But the Treasury seems inclined, based on what Trump recently said, to finance a lot more in the Treasury bill market, then wait until they have their loyalist as the new Fed chair and hope that the loyalists can get interest rates down. So I think a lot of the action is going to be on how we're going to refinance the debt.
Ed, where are the bond vigilantes? You coined that term. A lot of people have been saying they're in hiding. They're not doing their role. They're not picketing. We're not seeing those protests. Are they going to show up, or is that sort of an outdated term?
No, I don't think it's outdated. It's, you know, I coined it back in 1983, so we're talking about it now, and it's still relevant. However, the important thing to recognize is the bond vigilantes are not the only force in the bond market. There's the Fed, there's the Treasury now, and of course foreign investors. They're all, you know, important influencers of what happens in the bond market. I think the bond market it's hard to really short bonds here when you've got the President of the United States on Fox News saying that he's going to finance the next several rounds of debt, government debt, that he's going to refinance it with T-bills. We saw what happened back in November 1st of 2023 when Treasury Secretary Janet Yellen at that time did the exact same thing, and the bond yield, which got up to 5% in late October, just took a dive on that news. So it's hard to be a bond vigilante when you're fighting the Treasury.
They are not in a position to extend duration right now, that's for sure, Ed. Thanks for your time, sir. Ed Giardini of Giardini Research. Looking at the 10-year this morning, slightly softer, yields higher by 3 or 4 basis points. Let's call this 4.42. Just on the equity market, thinking about earnings season coming up, Max Kentner of HSBC put this one out yesterday. The bar to beat is very low going into earnings season. The big story in July, not this week's tariff deadline. It's the start of the reporting season next week. Any dip this week has to be bought very quickly.
July 15th, kicking off with JP Morgan and the bank earnings. A lot of people are expecting the earnings to be just like Ed Yardeni said, much better than expected, as they were in the prior quarter, and how much of a boost that gives really is that low bar that a lot of people are saying is easy to step over.
Equities doing okay so far this morning, just about unchanged on the S&P 500. With an update on stories elsewhere this morning, with your Bloomberg Brief, is Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump delayed imposing higher tariffs on U.S. imports until August 1st, while sending letters to countries detailing the levies that they'll face. The letters include 25% tariffs on goods from Japan and South Korea and plans for more than a dozen other countries. The president also teased the possibility of further talks ahead of the new deadline. And elsewhere, Apple's top executive in charge of AI models is leaving the company for Meta. Sources telling us here at Bloomberg that Roming Pang is joining Meta's new superintelligence team after being offered a package worth tens of millions of dollars per year. And President Trump says that he'll travel to Texas on Friday to see the devastation from flash floods, which killed at least a dozen people, 100 people, and left dozens still missing. The deaths include at least 27 children and staff from a summer camp. Recovery teams expect to find more victims as a search continues. That's your Bloomberg Brief. John.
Lizzie, thank you. Appreciate the update. More from Lizzie later this hour. Up next on the program, the White House buys some time.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders.
Up next, we'll catch up with Rob Casey of Signum Global Advisors, live from New York City this morning. Good morning.
Is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
In yesterday's session, snapping a 2-day winning streak on the S&P 500, the biggest one-day loss going back to mid-June. This morning, not much price action to speak of, pretty much unchanged on the S&P and positive by about 0.1% on the Nasdaq 100. Under surveillance this morning, the White House buys some time.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders.
All of those, to understanding correctly, are now deferred to August 1st, right?
Correct. There will be additional letters in the coming days. He is literally looking at the map and looking at every country on the planet and seeing where they are ripping off the American people.
So here's the latest. The White House confirming that President Trump delayed increasing duties on key trade partners until August 1, but threatened new tariff rates on countries including Japan and South Korea. Bloomberg's Tyler Kendall joins us now from Washington for more. So Tyler, explain the difference between what we heard yesterday and what we saw on April 2nd.
Yeah, hey, John, good morning. Well, by and large, the tariff rates that were outlined in these letters to more than a dozen countries were basically in line with what we saw on April 2nd. Some were marginally higher, Japan, for example, by 1 percentage point, but many were the same, including South Korea, as well as Indonesia and South Africa. It is worth pointing out that some were actually pretty lower, including Laos and Cambodia, the latter of which saw the largest drop from 49 to 36% when it comes to threatened tariffs. Now, we're really going to be watching to see if more countries come into this picture and if their rates change in a meaningful way. Bloomberg Economics says that this initial wave of tariff letters, these countries account for about 15% of U.S. imports. So there's still a lot of other trading partners out there. And you heard the White House press secretary indicate that there could be some more letters going forward here. Now, some of the things that we are watching when it does come to potentially how these tariffs could ramp up is that, well, all of these letters had a few different consistencies. One is that President Trump threatened that there could be higher tariffs if there are transshipments of goods. Of course, big questions here going forward about how that could be enforced. And then the second is any sort of retaliation. John, President Trump said that the U.S. will just slap on an identical rate if any country does retaliate in response to these letters.
Tyler Kendall with the latest down in Washington. More from Tyler later on this morning. Bramo, the difference. April 2nd, 24% on Japan. July 7th, 25% on Japan. All these tiny little differences between where we were back then and where we are now hardly make a difference.
But there is a difference in terms of the timing and what the market and all of us have experienced, which is a deadline's not a deadline. And that, I think, really set the tone for the path forward.
Let's build on that conversation with Rob Casey of Signum, looking at tariffs and writing the following. Consensus currently is that July 9th will simply become August 1. However, we would suggest being cautious around this view and staying on guard for tariff snapbacks sooner than then. Rob joins us now for more. Rob, good morning.
Morning.
You said it. A lot of people are feeling it. We can just look through all of this. Lisa explained it perfectly. Why do you think there is a risk of actual follow-through here?
Well, I think there's a risk of follow-through, A, because President Trump has not gotten the concessions that he wants in private negotiations or in public negotiations with posting these letters. And he is potentially running out of room, right? We may get a court decision on IEEPA this fall. Trump essentially has the opportunity to negotiate between now and then. So they're telling us they're getting closer, right? And maybe we get a bunch of deals over the course of the next week or today. If not, I think they probably want to push their advantage before, caving or taking a step back.
What's the deciding factor that dictates the shape of those deals? What's the difference between becoming the UK or Vietnam or Japan? What's the difference?
Well, I think that's clearly an open question. What we've seen in the UK deal, the Vietnam deal, among others, is, frankly, they're not very detailed. So I think that the deciding factor is the leader on the other side of the table is willing to accept what President Trump wants in broad terms, in vague terms, and maybe they're able to sell it to their domestic constituency, and then Trump is able to come back to us and say, we made a good deal. But that's not to say that these are, even the trade deals that are struck, they're still not very detailed.
When you talk about concessions the administration is looking for and they haven't received them yet, what exactly?
Well, across the board, I think there are really two. Trump wants to be able to message that he's bringing down tariff levels on U.S. goods being exported elsewhere. He wants to message that he's decreasing the trade deficit with individuals. I think that is probably the one with individual countries. That's probably the one that's going to get the most play from President Trump so far, because even when he's announcing, 25% on Japan, 25% on Korea, he's saying these tariffs are not enough to rectify the trade deficit. So he's still focused on the trade deficit. He still sees it as a problem, even at these higher levels.
When you look at things like the United Kingdom, Vietnam, even the slew of deals we saw on his Middle East trip, what happened to all of them? What is the process that's now happening behind the scenes within the administration to actually make sure the details of the deals get done? Who's working on that?
Well, I think it's behind the scenes, Anne-Marie, for a reason, right? We're not 100% sure.
Do they even have the staff?
Well, that's what I was going to say. Is 90 days ago, we heard 90 deals in 90 days, right? And that sounded impossible then, and clearly it was impossible, right? Not every country that has tariffs to be applied, today or August 1st, not every country has even had FaceTime with the president's administration. And so if you're a country saying we haven't even had the chance to negotiate, and now we're getting these tariffs slapped on at a higher level. Like, what are you supposed to do with that? So I think it's clear that there is not the bandwidth maybe that they had expected, because these deals aren't quite as easy as Trump, Best and among others, hoped.
There might not be the bandwidth. There's also a question about the framework and what kind of framework they're using to really understand what to extract from different trading partners. It's, buy more rice, buy our chickens, talk about, car exports. I mean, there's this question of raising the ante and using it as sort of a national security tool as well as a trade tool. Have we gotten any clarity around what the framework looks like?
Not a lot of clarity. I think one thing that we can see from both the UK and Vietnam is that President Trump wants to come back to the U.S. and message that we are able to send more goods elsewhere, right? And that's, broadly speaking, so far, I would say, mostly focused on the U.S. farm, ag industry. We also want to be able to sell more cars elsewhere, export, build up manufacturing capacity in the U.S. I don't think we can forget about a general goal of building up manufacturing capacity in the U.S. Each individual deal may not get us that much closer, but I think that's the overall trend, at least that President Trump is hoping for.
The goal is also to raise revenue, and this is sort of a key component with the One Big Beautiful Bill, and we did see the tariff revenue surge to a record $24 billion in May. How much is that sort of a sticking point at this point? They kind of have to keep rates high.
Totally. I think it's a major priority. Obviously, we don't really hear that from the White House, right? Because if we're talking about tariff revenue, then we also have to be talking about who's paying that revenue, right? And a lot of times, not all the time, but a lot of times, it's the American consumer. But the truth of the matter is, on the back of One Big Beautiful Bill, right, we are still in a deficit crisis. And so we have to find money somewhere. We didn't find it in higher taxes. We didn't find it in reverting to pre-Trump tax cut levels. We're going to have to find it elsewhere. And I just have to say, there is revenue to be had with tariffs, of course. But there is, I think, a broader point to make from now until August 1st, and that is, if we don't have the 145% on China, right, then we really are looking at only a marginal, I don't want to call it marginal, it's more than marginal, but we're not looking at a drastic increase in tariff levels, which means we're not looking at a drastic increase in revenue levels as well.
Did you mean to call it a crisis, or was that a slip? Because in the last week, we just passed a multi-trillion-dollar bill. It's hard to call it a crisis down in Washington. What makes it a crisis?
Well, the deficit may not be in crisis, right? Because we've run wide deficits for quite a long time, and we're all still standing. But the truth of the matter is, I don't think Republicans have a solution to the deficit, what they call a deficit crisis. Trump came into Washington describing the necessity of bringing the deficit down. Of course, we can all sit here and say that Democrats have failed to do it over the previous 4 years, but it's pretty clear that Republicans are going to fail to do it, at least in this Congress, and I think very likely over the course of Trump's term.
They're certainly not behaving as if it's a crisis in Washington.
And they just passed a bill that is deficit expansionary. The U.S. is going to be selling a net more than $220 billion net over the next 5 weeks alone. This really raises a question, again, where are the bond vigilantes? Are they just pegging their hopes and dreams in the fact that the Treasury is going to sell it all in T-bills? I guess so.
It's not in the bond market this morning. 496 on 30s at the moment. Yields are marginally higher by 4 or 5 basis points on a session. Rob, it's good to see you. Thank you, sir. Rob Casey there of Signum Global Advisors. Coming up next on this program, the former NEC Deputy Director Everett Eisenstadt, as President Trump signals he's open to trade negotiations. Plus, Yahira Arnott with your morning movers this morning as Tesla shares look to rebound. That stock is higher by a little more than 1%.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Michael Zezas of Morgan Stanley and so many others absolutely nailed this. Kick the can was the base case. Kick the can is exactly what we got just yesterday. Equity futures on the S&P 500 so far, little changed on the S&P following yesterday's losses. On the Nasdaq 100, firmer by 0.2%. With 3 hours until the cash open, let's get you some morning moves and cross over to Yahara Anand. Hey, Yahara.
Good morning, John. We start with renewable stocks. They are lower in the pre-market. That's because yesterday Trump signed an executive order calling for even tighter limits on clean energy tax breaks. That's after those incentives were already scaled back in his $3.4 trillion budget. So as a result, you are seeing First Solar down 2.2%, Sunrun down 5.5%, while Enphase and Solar Edge are also lower. Moving on, we have Tesla, worth taking a look at after the stock fell 6.8% yesterday on that news that Elon Musk was forming a new political party, drawing fire from President Trump. But today, it is bouncing back up about 1%. I will note that the next big catalyst for this stock is about 2 weeks away on July 23rd, when Tesla reports earnings. And I want to end with Nike. Shares are slightly lower, down 0.6%. That's after President Trump sent letters to the likes of Cambodia, Indonesia, and Thailand saying that they will see a 36% tariff if they don't strike a trade deal with the U.S. These are the exact places that Nike and other shoemakers and apparel makers diverted production to in order to diversify away from China. And this, of course, comes on the heels of that Vietnam trade deal, which cut expected tariffs down to 20%. That did add some certainty for the likes of Nike, but this is also a company that's in the middle of trying to stage a turnaround. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, our top story, the president ramping up pressure on trading partners, posting letters to several nations threatening high tariff rates that would go into effect on August 1st. Trump then saying the deadline and tariff rates are not 100% firm.
So obviously what you see right now is another fluid situation. The dates keep changing. It was supposed to be 90 deals in 90 days. Maybe they'll get 90 deals in 113 days. We don't know. What is obvious is that they don't have the bandwidth, especially speaking to Rob Casey. They don't have the bandwidth behind the scenes to go after all of these countries at once. We are still waiting on actual firm deals and what the framework will look like for these firm deals. Do they take a Vietnam approach? Do they just take a de-escalation approach like they did with China? Or is there actually some sort of deal on the margin, like when it comes to United Kingdom, when they actually discuss specific rates and agricultural going in or out, cars, et cetera? So many questions when it comes to what is going on with the trade policy.
For a company, what does this mean about trying to come up with policy and strategy going forward? How do you invest longer term? How do you understand where to make your goods? Do you just expect that they're going to be higher bills as a result of them? Do you start charging them? Do you start front loading as quickly as you possibly can in the next 3 weeks? Does a policy of uncertainty have a drag? And that, I think, is really going to be one of the key questions.
That's the C-suite. We've got to think about the policymaker as well. We'll find some space this morning to talk about the Federal Reserve, whether you think they should or shouldn't cut interest rates. Put that to one side. They've established their threshold to reduce interest rates. They want to know what the policy is, show me the tariff, and then they want to see the outcome of the tariffs and just wait and sit for a little while. The fact you've extended this from July 9th to August 1 makes it difficult to do anything. They certainly can't signal anything at the end of the month, because at the end of the month, they still won't know what the tariffs are.
That's a moving goalpost, and so the Fed's policy roadmap is going to have to also be a moving goalpost, because they're going to say we have to operate with a modicum of uncertainty and make that call without that data, because that's essentially what they're being tasked to do.
Lisa mentioned the corporate response. Worth going through the corporate reaction so far. Porsche warning of a challenging road ahead after reporting a slowdown in U.S. sales and persistent weakness in the world's #2 economy, China. Global deliveries falling 6% in the first half of the year, led by a 28% slump in the country, driven by fierce domestic competition.
So this is where it gets complicated. How much are companies going to use tariffs as a fig leaf to cover up a whole host of other issues? And there are a confluence of issues in the auto sector, competition from China, the transition to electric that's coming at a time that's pretty fraught in terms of where you get the materials, in terms of the U.S. policies. And Porsche is at the epicenter of all of those. In terms of tariffs, they should be the ones to weather it the best, because ultimately they can pass along the cost, because if you're buying a Porsche, you could probably afford a couple extra $1,000. So that's the reason why I'm watching this as sort of the excuse, sort of the currency differentials that people use sometimes, or other types of platitudes to cover other strategic issues that they're facing.
You think it's fair to say for the European brands, the bigger challenge right now is not the tariffs, it's the competition in China?
100%. If you take a look at the exports from China, they're not necessarily going down. They're just not going up to the U.S., but they're going up everywhere else around the world, including to Europe.
When you look at what China's doing in BYD, they actually unveiled in December a prototype that looks like the Porsche 911. It is incredible what they're unveiling. And obviously they're at a cheaper cost if you're buying in China, and that is why you see just basically off the cliff sales when it comes to Porsche.
That's the latest on Porsche. If you're waking up this morning, on your way to school, college, whatever it might be, and you're thinking about what to do, earn some cash, if you want athlete money, join Meta, going all in on efforts to reshape its AI leadership, with the company hiring a top executive from Apple at an offer worth tens of millions of dollars per year. The CEO, Mark Zuckerberg, has reportedly been heavily involved in the recruiting process, and we've seen headline after headline over the past few weeks.
I would just argue that these aren't people who are, 18 and in college looking for a summer internship. But that said, this is the Trojan horse. And you said this, Anne-Marie, and I'm copying you because I think that it's brilliant. This idea of, rather than buy one of the competitors, just hire all of their top talent and hire it from the weak players. Sort of like going after blood in the water. Apple really having trouble getting off the ground with their AI offerings. Well, just take their high talent and, call it a day. And I wonder how much they're going to benefit from it.
He's gone after the strong players too.
Yeah.
Over at OpenAI. Look, I think this is Mark Zuckerberg essentially telling us all he sees this as a real existential risk to his company. Winner takes all, and he's willing to pay whatever it takes.
And he's been right. He was right with Instagram. He was right with a whole bunch of other acquisitions. And frankly, a lot of people, if you take a look at the performance of the stock, are betting that he'll be right again.
Meta this morning in the pre-market higher by 0.6%. We'll come back to that story a little bit later. Let's turn back to trade. President Trump unveiling new tariff rates on trading partners while delaying the deadline to August 1. The former NEC Deputy Director Everett Eisenstadt writing, one thing remains clear. The president is laser focused on achieving balanced trade through reciprocity and committed to aggressively using tariff authority towards that end. Everett joins us now for more. Everett, welcome to the program. We're trying to understand how different August 1 will be compared to July 9th, which hasn't happened yet. What will the difference actually be?
Well, good morning. We'll have to wait and see. I think many people believed and hoped that this July 9th postponement deadline, when it ended, we'd have greater certainty and clarity as to which countries were going to be able to negotiate a framework agreement with the president and which might get higher tariffs. And we don't know today. We know that certain countries will have their tariff rates set. There have been some letters that have been issued. But then again, the president reserved the right within those letters to raise those tariffs up and down, depending upon the relationship with the country. So there's still a lot of story to be told. There's still a lot of negotiations to go on, and we'll just have to wait, and hopefully we'll see some more deals come out between now and August 1st.
I think it's fair to say it's very ambiguous. And when you look at some of these letters, Japan was 25%. As of yesterday for August 1st. April 2nd, it was 24%. Kazakhstan was dropped from 27% to 25%. Tunisia, 28 to 25%. You get the point. Why? Why are these rates like a percentage or two off from April 2nd? What is the methodology behind any of this?
Honestly, I think some of the methodology is to simplify the rates a little bit and to put them in buckets. And I suspect that what we'll see at the end of the day when we get a bigger picture of how many countries and what the tariff rates is, that they're going to be categorized by were they willing to put forth an offer? Was the offer made in good faith? What's the trade deficit? Obviously, that's going to be a key factor because he cited that repeatedly in his letters. So there's a number of tells there, but we don't know, and many of these countries don't know what they need to do or what they can do to find a pathway to stability, and that's what they want. You saw with Vietnam, they agreed to a 20% tariff. Why did they do that? Because it gave them some predictability for trading over the next several years, and that's something that's quite valuable.
Everett, basically what happened yesterday is the president came out and said everyone just gets an extension. Why put these letters out for certain countries?
Well, I think the reason the letters were put out is because those countries are the ones that he believes have some of the most pernicious trade deficit problems. And for countries like South Korea and Japan, those letters were probably quite shocking. Both countries have a special national security relationship with the United States, have a special trading relationship. They invest billions and billions of dollars in the U.S. economy, create many, many jobs, and they export from the United States. So I think they both believe that they would be treated a little bit differently and have some dispensation. The letters basically are saying, look, you need to take action, and the special relationship matters, but it's not enough to discount what the president sees as unfair trade practices.
Everett, is the United States losing leverage as long as this process goes on and the can keeps getting kicked?
The more leverage we can, leverage matters. We do have a lot of leverage. It's important to use it very strategically. And one of the best ways to use leverage is to demonstrate that it works. And that's getting a deal done, and a deal done that someone can look to and say, oh, that's achievable. I can do that. And it's a motivator. I think if this continues and there's no framework set and the tariff rates keep being pushed down the field, which I don't think they will be, that does over time lose a little bit of the leverage. And perhaps, some economies just get resigned to say, well, okay, this is going to be my tariff rate. I'm going to adapt to that because at least I know that's predictable. So I do think that the leverage is something that needs to be used and used well, because over time, if you don't use it, you're going to lose it.
How much is this drawing countries closer to the United States versus pushing them away to form trade blocs with one another, if that's more of a certainty?
Mm-hmm. That was happening anyway. There were a number of countries that were coming together trying to form their own trade frameworks amongst themselves. And part of the reason was because it wasn't just President Trump. I mean, even under President Biden, there were no trade negotiations ongoing in the United States. You may recall, prior to that, prior to the first Trump administration, we'd negotiated a flurry of trade agreements and locked in very good outcomes with a lot of countries. This could put forward that kind of dynamic where countries are looking to negotiate amongst themselves. I do think, though, that the whole playing field has changed. The kind of agreements they're going to negotiate are going to be very, very different than they were, say, back 90s, 2000s. They're going to be more focused on economic security, national security, secure supply chains, and they probably won't be as comprehensive as they used to be. So the president's definitely having a major impact on global trade, and also one that I think is going to last for probably decades to come.
Everett, we'll see in about 3 weeks, I hope. We'll catch up soon. Everett Eisenstadt, the former NEC Deputy Director. Art of the deal: exhaust the other person at the other side of the table, and they'll accept whatever you want. I think at this point, we'd all take 10-15% and move on, wouldn't we?
Are you talking about us being exhausted by this process?
Investors,
exactly.
Countries, whoever it might be.
That said, they've got to move on, and they have to understand how to protect their industries and how much they've created side deals with other partners, and how much does it push people to say, look, can we really move away from China if we're not sure what the relationship with the United States really is going to be?
Also, Everett was talking about how the letters for South Korea and Japan were quite shocking. There's another school of thought. For Japan, actually, President Trump did a favor to the prime minister because they have an election at the end of July, and they could not have a trade agreement with the United States where they gave up key industries like you talk about when it comes to rice or the auto sector when you're up against serious sensitive domestic politics.
It's well framed in the same way the president dealt with Nippon Steel and that situation going into his own election. Equity futures this morning positive by about 0.1% with an update on stories elsewhere this morning. With your Bloomberg brief, here's Lizzie Burden. Hey, Lizzie.
Hey, John.
The president also hosted Israeli Prime Minister Benjamin Netanyahu at the White House last night. The Israeli leader told Trump he nominated him for a Nobel Peace Prize. The US is pushing for a ceasefire in Gaza that could end more than 18 months of fighting and see the release of the hostages still being held by Hamas. And more than 100 people have been confirmed dead in floods that tore through central Texas over the weekend. Local, state and federal officials have faced criticism in the aftermath of the tragedy. Senator Ted Cruz downplayed concerns that President Trump's cuts to the National Weather Service played a role in the failure to evacuate people. And Novartis has won regulatory approval for the first medicine specifically designed to treat malaria in babies. The drug maker says that until now, infants were treated with tablets meant for older children adjusted for weight. In 2023, the World Health Organization said that there were nearly 600,000 malaria-related deaths, with children under 5 accounting for 3 and 4 deaths. And that's your Bloomberg Brief. John?
Lizzie, thank you. More from Lizzie in the next hour. Up next on the programme, the cost of prolonged uncertainty.
And the further we stretch out the tariff issue, the more likely it is that the growth issue will come first. So we are expecting slower growth in the third and fourth quarters and a rate cut by the Fed in September.
In just a moment, we'll catch up with Kelsey Barrow of JP Morgan Asset Management, live from New York. You're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's another sleepy start to a trading day. Good morning to you. Equity futures on the S&P 500 just about positive by 1/10%. On the Nasdaq up by 1/4. Under surveillance this morning, the cost of prolonged uncertainty.
And the further we stretch out the tariff issue, the more likely it is that the growth issue will come first. So we are expecting slower growth in the third and fourth quarters and a rate cut by the Fed in September. 2s, 10s could move up another 30, 40 basis points pretty easily. There is room for further steepening of the curve. My concern is it might be more of a bear steepening at this stage of the game.
So here's the latest this morning. U.S. Treasury yields rising as President Donald Trump extends the tariff deadline to August 1. Kelsey Barrow of J.P. Morgan Asset Management writing the path of least resistance for the shape of the curve in both the U.S. and Europe continues to be steeper. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
We'll get into the yield curves in just a moment. I just want to talk to you about something Lisa mentioned earlier this hour. What is the price of this prolonged uncertainty, moving this deadline from July 9th to August 1?
I mean, I think the price is probably a sub-trend growth environment, which is the environment that we kind of expect for the upcoming quarters. One where you have some things that are pointing to, upside risk to growth, particularly the one big beautiful bill. On the other hand, you have the tariff risks and the tariff revenue, which we would view it as a tax, and these things are kind of offsetting. Ultimately, it's kind of an environment where you're treading water. It's the same way that we describe the labor market, the low hire, low fire environment, one where you're just kind of stuck in the middle.
Is the Fed stuck in the middle as well?
Yeah, I mean, I think that's probably a good way to describe where they are right now. We don't think that they're going to be cutting rates in July. We've seen that repriced from about a 20 to 30% probability down to 0. That was a function of the July jobs report, which, while weaker under the surface, the headline jobs number around 150,000, the unemployment rate ticking down to 4.1. You kick the can down the road on that. The next question is, what are they going to do in September? We see the dynamics in terms of inflation and growth, and we hear the commentary from Chair Powell. I think it's actually been increasingly clear, which is that if it wasn't for the concerns around inflation and tariffs, the Fed would be cutting already.
It's sort of this interesting moment where people are looking at the long end of the yield curve and saying it should be steeper because of deficits, because of potentially a prolonged level of inflation. And then you have the Treasury Department saying we're just going to issue and finance our entire deficit on the front end. Can they do that? Would that be sort of accepted by markets?
Yeah, I actually think they can do that. So we've gone through and we've run the analysis in terms of how much additional supply do they need and can they fund that exclusively through bills. Ultimately, that is going to slowly reduce the weighted average maturity of their portfolio and going to increase their rollover risk over time. But we do think that they'll be able to keep coupon sizes the same and increase bill supply at least for the next 2 years. And that's a trend that you're not just seeing in the U.S., by the way, right? You're seeing that active management by the debt management offices, not just in the U.S., in the U.K., in Japan. They're all kind of dealing with similar issues.
Is this a backdoor way of monetizing the debt? Is this a backdoor way of saying we're going to issue on the front end and, by this way, we're going to pressure the Federal Reserve to drop rates as low as possible so that we can reduce our funding costs for the indefinite future?
I wouldn't put it that way. What I would say is, what we're transitioning to, and we've been transitioning to, is an environment where you started with mostly price insensitive holders of fixed income to mostly price sensitive holders of fixed income. So it was the central banks setting the price 5 years ago. It was the public sector that was the dominant driver of markets. And we're now moving into an environment where it's the private sector, it's the asset managers who are the price setters, and on the margin, they're demanding more term premium and higher yields.
What does it mean if you don't see some sort of rally on the long end in response to a lack of supply? If you don't see any, say, 30-year issuance or very little around the world, does that mean that yields go down, that actually there's more demand for that paper, or does that render it just sort of an obsolete maturity?
Yeah, I mean, the adjustments in the maturities are not a silver bullet. So just because the Treasury is going to be focusing on bills doesn't necessarily mean that we should expect lower 10 or 30-year Treasury yields. But I think you always have to differentiate between, your structural view. You can have a structural view that yields over the course of a cycle can be higher, but that doesn't preclude that on a cyclical basis, yields can still move lower if we're seeing weakening in growth, weakening inflation, and the Fed cutting interest rates.
Well, when it comes to the Fed cutting, how challenging does now the moving goalposts of the tariff date make their decision? Especially also August 1st is when we'll get July payrolls. Is that enough time for them to cut in September, which a lot of people in the market believe?
It is tricky because, they've been saying all year, they've been on hold for 7 months, right? And they've been saying we need more clarity, we need more clarity. And maybe the clarity they're getting is the fact that they're not going to get clarity, and eventually they're just going to need to move forward with the information at hand. And I think the information at hand is going to tell them that ultimately additional rate cuts are expected. Or should be anticipated. And I think the real thing that we're focused on as it relates to the inflation is let's not debate from month to month, are we gonna see an increase in core goods inflation this month or next month? That's kind of a fool's errand. What is the broader inflation backdrop telling us about the strength of the economy? And when you look at services inflation, shelter inflation, the other parts of service inflation that are cyclically oriented, like airfares and lodging, they're telling you that cyclically the economy is weakening. And that's ultimately the signal that the Fed is going to be looking at, not the kind of one-time price adjustment risk from the tariffs that they were concerned with at in April.
Listening to the chairman, he's told us pretty clearly he's waiting because he thinks he can. He's waiting because he believes the economy's solid. If he's cutting in September, it's because it's not anymore. If they believe they want to wait and see what happens with the tariffs, they're going to have to wait beyond September. That's why I think if you're making a call now for September cuts, I think you've also got to make the call. There's got to be a degree of weakening of the economy at the same time, haven't you?
Yeah, but I think that you are seeing that weakening in the economy. So if you look at the payrolls report, if you exclude the government jobs, private payrolls was weaker than expected, and it was very concentrated in just a few areas. I think the other thing that caught my eye was hours worked continues to fall, right? So you may not be losing your job, but you're working less hours, which is an indication of less demand. And then I look at the consumption data. The consumer's been strong. They've been held up by decent income growth. But at the same time, the Q1 real consumption data was revised down. The Q2 real consumption data is tracking a little bit on the soft side. Now, we'll get more information on that in retail sales, which isn't this week, but next week. And so, I think that ultimately this is kind of a sub-trend, muddle along environment where the risk of reacceleration is not necessarily supposed to be your base case.
Which typically is a screaming argument by the 10-year and beyond, but it's not anymore.
Well, it's not about the 10-year. Now it's all about the short end. And right now there's a real question about the supply-demand dynamic and how much Treasury Secretary Bessent is the ultimate kingmaker in the bond market.
Kelsey, it's good to see you. Thanks for dropping by. Kelsey Barrow there of JP Morgan Asset Management. Up next on the program, Evan Brown of UBS, Sarah Bianchi of Evercore, the Daimler Truck North America CEO, John O'Leary, and ARK Investments CEO, Kathy Wood. Live from New York, the second hour of Bloomberg Surveillance. Up next.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
We still prefer the U.S. equity market to other markets globally. The U.S. is also the single biggest destination still for dynamism.
We're uncomfortable with where multiples are, which is why we think that you're likely to have a pullback.
You're at a gazillion miles away from a sell signal.
People are underappreciating the risk to the upside.
The next couple of months, you could see more volatility. But near term, you get the chase.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this in the equity market. Equity futures on the S&P just about positive by 0.1%. The tariff levels, the threats are very similar. The price action is very, very different. We were down 5%, down 6% following April 2nd. Nothing like it anticipating July 9th. As July 9th now becomes August 1, equity futures are positive by 0.1%.
The date and the moving goalpost more important at this point than any levels that we get in terms of potential tariff rates, because they are temporary and they are not going on until August 1st. And at that point, we might have different ones to look at. This is a market that has gotten benumbed to every single headline. And it goes to the question, what will shock it? Rob of Signum Group coming out earlier and saying, ultimately, Rob Casey, this is going to be different this time. And at what point will this market wake up to that? Is that a possibility? And how much is this sort of training grounds for a complacency that we've seen time and time again?
It's a big subject of debate so far this morning. For the threat to be credible, it needs to follow through. And right now, a lot of people don't believe this president will follow through.
Which is why I was only having deja vu when I looked at the tariff rates, because they're pretty much the same as Liberation Day, maybe a percentage or two off when it comes to certain countries, but the market impact was definitely different. That idea of taco, Trump always chickens out, has really gotten a hold of the market. They think that this is incredible because he'll just extend and delay yet again. What I think could be impactful for the market if it's to the upside, if Trump comes out and says, look, I got a deal with India, we're really close to a deal with the European Union, some big trading partners, that could potentially be changing when it comes to the trade story.
Lisa mentioned some of the companies and how corporations respond to some of this. I think they got a pass last earnings season on the calls just to say, we don't know, can't provide you with guidance. Did they get a pass this time around, this upcoming earnings season?
It's a difficult question, and it probably depends on the sector and how quickly some of the tariffs go on. So if the tariffs have already gone on, then you'll see where they've passed along price increases. We've seen that with certain retailers. If people have been able to hoard some of the products and then sell them at base prices, you're not going to necessarily see that read through. But really, this is the ultimate question. Have we seen the impact of the tariffs so far on consumer prices? We get CPI next week. And that's a key question. Some people saying, look, we can adapt and adjust and this is all just fine. And other people saying, just wait.
This week, we get to ask the airlines, here's your week ahead. So July 9th is no longer that important. We've got some economic data. Jobless claims are doing okay based on the data we got last week. Delta Airlines report on Thursday. They gave us an early snapshot of some weakness that started to emerge in the economy earlier this year, back in February. What are they going to say later this week?
Probably some of the same. We've heard that, although United came out and said a couple of weeks ago that they are expecting a rebound in the second half. They've been pressured by the domestic consumer base, and this goes to the question that we really have been grappling with. Is the policy of uncertainty and, frankly, some of the weakening that we were just talking about with Kelsey Barrow, is that already showing up in terms of people being more discretionary about flying to Cincinnati and Milwaukee?
Lots of drama if you received one of those letters. No drama so far this morning in this equity market, positive by 0.1% on the S&P 500. Coming up this hour, Evan Brown of UBS Asset Management staying overweight equities. Sarah Bianchi of Evercore as President Trump leaves the door open for trade talks. And the ARK Invest CEO, Cathie Wood, on Tesla's latest slide. We begin this hour with stock steady as President Trump signals he's open to more trade negotiations. Evan Brown of UBS writing, we think the market can look through this soft patch as rate cuts, fiscal stimulus and AI-led productivity gains set the stage for a better 2026. Evan joins us now for more. Evan, good morning.
Good morning.
Are you already done with 2025?
Yeah, that's right. I mean, we're not of this view that the economy is just going to sail through the second half. We think the economy will cool as these tariffs take effect. It's just the market gets that at this point. And the fact that, yeah, the hard data will be deteriorating a little bit, the soft data is improving. And historically, when you have these kind of shocks, the soft data goes down first, the hard data follows, but once that soft data rebounds, the market kind of doesn't care about the hard data declining.
What's more important to you right now? Dear South Korea, dear Japan, dear whoever might receive a letter, or the earnings that we're going to see in the next few weeks?
Yeah, so we're less focused on the, each individual bilateral trade deal. What we want to hear is from the companies themselves and what they're doing, how much they're absorbing in margins, how much they're passing through to the consumer. Again, we expect effects. We don't expect these corporates to say everything is just fine. But at the same time, we've seen particularly U.S. companies just be remarkably dynamic and adaptable to what we've seen as a multitude of shocks over the last few years.
So John put me on the spot and I answered as best as I could, but you could answer it better. Are they going to get a pass again in terms of being able to give forward guidance of what the year ahead looks like and how exactly those tariff costs are going to be borne out?
Yeah, I think, look, it's still a moving target with the tariffs. And so, I think a lot of companies will say, oh, we're still working it out. We're still figuring out the exact layout here. But I think there will be, you can expect more specifics coming from these individual companies. But I think, as you said earlier, it's going to be a little bit more company by company, sector by sector, and less of a big macro issue and more of a micro issue.
We're trying to put a narrative to something, and I wonder if it's sort of a fool's errand on a lot of levels, but partly whether we're just looking at a rally generated by systematic fund rebalancing, whether we're looking at share buybacks, and just still a lot of liquidity in the system that needs to go somewhere more than we are any kind of cohesive economic or policy narrative.
Yeah, look, we go on TV and we like to, like you say, put narratives on everything. I will absolutely admit that there is a huge technical angle happening here where you essentially had the market completely freak out and capitulate with Liberation Day. By some metrics, same kind of capitulation that we saw 2008 and in COVID. And then now there's this massive chase. And look, I mean, there's $7 trillion in money markets, and that money is going to have to come in, as you said, systematic strategies.
Hold on a second.
Jumping in.
Everyone's been saying that.
Yeah.
I beg to differ. If there's risk there and you're getting paid 5% for cash, at what point is it not going to go into equities? Is it not going to be some sort of boost, but frankly, an investment in itself?
Yeah, I mean, in the end, we'll talk about different valuations and what you earn and everything like that, but in the end, it comes down to risk appetite, right? Markets are behavioral, so love to put fundamental stories on everything, but the market has been going higher. and that's going to pull people in, and it will take a meaningful shock, I think, to disrupt that. Now, I've said that the hard data, we're okay with it coming down, but if the big risk is we just have the economy completely wrong and the labor market breaks. Now, it doesn't look like that's happening. We saw a decent labor report on Thursday, but that, I think, is the key risk here more than the tariff noise.
On the policy side, what could be the catalyst to the upside or the downside? Because you correctly note that basically the tax cuts and the tariffs cancel each other out.
Yeah, so I think so the tax cuts and the tariffs, it's kind of a sequencing issue. The tariffs hit right now, that hurts. Tax cuts are going to really come through in early 2026. So that's a bit of a wash. I don't know that you need to have meaningful positive catalysts. I think things need to just be okay, and then those natural technicals will flow through, and the markets will keep grinding higher. You feel silly making these arguments, but this is the reality of the market.
This is the exhaustion we were talking about in the previous hour. People are conditioned to buy, get out of the way, they'll keep buying.
And that's part of the reason why people are trying to come up with a rationale. Are things so much better now than they were before April 2nd? No. Why are people ignoring this? It's the way that it goes. And right now there's a lot of cash and people capitulated and they're coming back. I just wonder if there's a breaking point. And that, I think, would be the economy, to Evan's point.
Forgive me for getting back to the fundamentals. Let's talk about the economy and what the market's pricing. Inconsistent markets, apparently, according to Torsten Slock of Apollo this morning, who says the bond market continues to price the next Fed move to be a cut with the expectation that growth is slowing down. That's fixed income. Equities. The stock market is trading cyclicals higher relative to defensives with the expectation that growth is about to accelerate. Can you make sense of that for us?
Yeah, again, I think it's a sequencing thing, right? So part of the slowdown, the bending but not breaking of the economy that we expect is going to lead the Fed to cut rates. And I think that's going to ease financial conditions and support the economy into 2026 along with those tax cuts. And so as the market looks through, you see cyclicals start improving versus defensive.
That all sounds quite cute, doesn't it? The bond market's pricing in the slowdown that leads to rate cuts, so the market's responding to the rate cuts you might get because of the slowdown that the bond market's priced for.
Because people don't believe that the slowdown is going to be that significant, and it's going to be a temporary thing that'll be offset with monetary policy. Yes, exactly.
We should start a podcast. This was great. Evan, thanks for dropping by. Evan Brown of UBS Asset Management. Torsten, if you're watching, there's the explanation. Apparently. Does that all make sense to you?
This is what a lot of people have been saying, that ultimately if there's a slowdown, it's not going to be a recession, and then you can get through it. The Fed's going to help get to the other side. And as we can see, the equity market's already in 2026, so 2025 doesn't really matter. It's a write-off, and if you get rate cuts, you're good. There is this question about what are we missing in the labor market, and I sound like Negative Nelly, but that is something that you have to watch about, as well as inflation. Can the Fed cut rates? If you have inflation that does pick up in any kind of way on the heels of tariffs, and this really does become an increasing issue heading into the fall.
It's on brand. Embrace it. Sounds good.
I feel terrible because people come on and they're so positive and they're like, I'm like, yeah, but what about
got to offset
nuclear war, and
that's what the news is for, Bramo.
It's morning, really?
Good morning. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Lizzie Burden. Hey, Lizzie.
Hey, John. Brazilian President Lula da Silva is joining South Africa in blasting President Trump for his threat to slap extra tariffs against BRICS nations. He's accusing the US of being irresponsible and called on world leaders to find ways to reduce international trade's reliance on the dollar. And President Trump says that he'll ship more weapons to Ukraine. Trump made the comments at a dinner with Israel Prime Minister Benjamin Netanyahu last night, just days after speaking to Ukraine's President Volodymyr Zelensky. The decision comes after the Pentagon halted flows of some air defense missiles and artillery shells to Ukraine. And travellers may get to keep their shoes on while going through standard airport security checkpoints. Sources telling us here at Bloomberg that the Transportation Security Administration is planning to update its policies to make the change. It's a move that would extend a benefit already available to individuals who pay for TSA pre-check. That's your Bloomberg Brief. John.
Lizzie, thank you. What's wrong?
Oh, my God. Lisa doesn't have pre-check. I'm never traveling with you.
Literally, honestly, this is like, I feel bullied. I feel like...
Clear?
No, I feel like Clear is actually...
It's now busier than the normal line.
I feel like it's a violation. I feel personally offended by Clear.
I have Clear and pre-check.
Hold up. Give her a chance. Why do you feel violated by this?
Because you've got to pay to play in this profound way. It's not just sort of a security thing. It's this idea of if you pay, you are shepherded in front of a long line of screaming babies. And you just, you know, it's just, I feel like it's unfair and it would be sort of hypocritical for me to
Some
join.
people watching this morning will think you're the smart one. Because if you go to the airport at the moment, on many an occasion, the normal line is the shorter line. TSA pre-check everyone seems to have now. Clear, everyone seems to have
You gotta
now.
have both. Before I feel
And you switch
self-righteous,
between?
all I could say, before I feel self-righteous, I waited for 45 minutes yesterday to get through
Did
security. So, but I didn't have to take my shoes off.
And you don't have
yay.
so you don't have global entry.
I know. I mean,
So you don't have global entry.
I'm indefensible.
Hey, mate, you are judgy this morning. Jeez. Up next on the program, leaving the door open for trade talks.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders.
Up next, we'll catch up with Sarah Bianchi of Evercore, live from New York City this morning. You're watching Bloomberg TV.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
In case you missed it on Bloomberg Surveillance, in the commercial break, AMH just called Lisa Ratchet. I have not heard that word. I have not had that word in forever.
Bougie Ratchet, right? I just think of that song.
Wow.
It's just like, you're wasting so much time. It's crazy to me that you don't have this.
I think I'll take the rest of the morning off and I'll go get it. So I'll see you later.
I'll come with you. All right. Equities so far, if you're just tuning in, good morning to you all and welcome to the program. Futures positive by 1/10% on the S&P. On the Nasdaq 100, we're up by 1/4%. Under surveillance this morning, leaving the door open for trade talks.
The president will also sign an executive order delaying the July 9th deadline to August 1st. So the reciprocal tariff rate or these new rates that will be provided in this correspondence to these foreign leaders.
All of those, to understand you correctly, are now deferred to August 1st, right?
Correct. There will be additional letters in the coming days. He is literally looking at the map and looking at every country on the planet and seeing where they are ripping off the American people.
Here's the latest this morning. The White House unveiling a wave of letters sent to key trading partners threatening higher tariff rates, including a new 25% levy on goods from Japan and South Korea. Joining us now from the nation's capital is Tyler Kendall. Tyler, we couldn't achieve it in 90 days. What difference does an extra 3 weeks make?
Yeah, hey, John. Well, when we look at actually the tariff rates here, they're not marginally different, as you've been pointing out on the program. Japan, for example, is only up by 1 percentage point. Many of these countries are facing the same levels, the same sort of threats, like South Korea, also Indonesia, South Africa. I will point out, I think it's worth mentioning that some did see lower tariff rates, and perhaps that could boost their odds at getting a deal, such as Laos and Cambodia, which actually saw the biggest drop from 49 to 36%. Essentially, though, we heard President Trump indicate that these are the countries that the U.S. at the moment are most frustrated with when it comes to trying to work towards a deal. And that's one difference between now and April 2nd when you look at which countries were prioritized for the letters. Japan and South Korea, our understanding have long been prioritized in the talks to get a deal for a multitude of reasons. We've repeatedly heard from U.S. officials that these were the countries that came early and often to the negotiating table, not to mention the strategic components here when it comes to competition with China. At the end of the day, though, it does appear that this perhaps 3-week extension could be fluid going forward. President Trump said that August 1st was firm, but not 100% firm, in his words, indicating that he's open to negotiations and that even these updated tariff rates could ultimately change at the end of the day. John, we are expecting more letters. You heard the White House press secretary there. Bloomberg Economics says that of the countries that have already received letters, they make up about 15% of U.S. imports.
Tyler Kendall with the latest. Tyler, thank you. More from Tyler later in the program. So we've got some extra time. Joining us now to discuss, Sarah Bianchi of Evercore. Sarah, welcome back to the program. How is the administration, the White House and trade partners going to use that extra 3 weeks?
Well, I think that you guys are right to say that what the White House is trying to do here is to signal countries where they are frustrated. Although South Korea and Japan early on were places where the White House was hopeful for a deal, they've really gotten stuck in the conversations around sectoral tariffs, or particularly around tariffs on autos, steel, some of the largest imports from those countries. The ASEAN countries, Cambodia, Indonesia, I think they're trying to follow more the model that we saw briefly outlined around Vietnam. So I think we're doing some signal sending. The administration has, I think, always been very, very optimistic about how many trade deals or even frameworks one can cut in a period of time. So I really just viewed yesterday this first set of letters as an indication of where, at this moment, the White House believes things are not on the path they want to see.
How powerful is the signal, though, when the president says it's firm but not 100% firm?
Yeah, well, I think, you know, there are certainly some in the markets who are just going to shrug this off because we have seen delays. We have seen this kind of high, tough talk before. I think what we would remind investors and other stakeholders is that right now, we do see the directional tariff rate in the next coming weeks going up. We're seeing countries like Vietnam ending up at higher than the sort of 10% baseline we've been at, and we have more sectoral tariffs. So some of this is just Trump negotiating that we've watched for a long time. But I think also we're at really high tariff rates right now. We're already at about 15%. And again, in our minds, the next signal points upward.
Sarah, do you have a decent understanding of what has been demanded by trade partners? Has the White House articulated that? Do they know what they need to do to get the tariff that's been put in a letter in the last 24 hours to get that tariff lower?
I think it really depends on the partner. I think certainly countries like Japan and Korea understand where the sticking points are, even though they don't like it. They just really, particularly, they've got their own politics. For example, in Korea, it's a very new government. Japan has an election coming up. They need relief on autos, really. So I think they understand. I think the bid ask is just at this part too far apart. Other countries, I know there is bandwidth challenges given how many countries are negotiating. So a country like Cambodia may be having trouble getting all the airtime they need to sort this out. I think it really depends on the partner. Interestingly, you know, EU, that it's been traditionally very sticky, difficult trading partner for the Trump administration, they seem on track. So this is just kind of, you know, a snapshot of where we are in this inning.
Sarah, what do we mean when we talk about getting deals? Because it seems like the details of these deals are actually very foggy, and it takes a long time. You've been intimately involved in crafting some of these deals. How realistic is it that they could be more than a framework anytime in the next few months, given just what goes into some of these negotiations?
Well, these are very, very high level, as you point out. For example, on Vietnam, one of the touted deals by the Trump administration, we haven't even really seen paper. And one of the big questions for Vietnam is they got a bifurcated tariff rate. They got 20% and then 40% on transshipment. Transshipment can mean lots of different things and can have lots of different implications. So these are extremely high level. And look, you have trade irritants with trading partners because there are sensitive political and economic issues, and they take a long time to work through. So the notion that we were ever going to get, 90 deals in 90 days was certainly thought of somebody who hasn't spent a lot of time negotiating trade.
Well, now it's 113 days, and I think a lot of people are questioning whether or not you can even get a dozen of deals done by then. When can we expect the sectoral tariffs to actually be announced?
Well, that's been interesting. Some of them are rumored to be coming any day now. Copper is supposedly close, lumber. I think the biggest ones that we're watching are on semis and the pharmaceutical industry. Those are very large sectors of the economy and very important from, particularly on semis, an inflationary perspective about where the administration goes. I think there's still a lot for the administration to sort out. But the way we have seen this president operate in sectoral tariffs so far is he comes out with 25%, pretty broad, and then negotiates from there. So far, they have been stickier in those negotiations. That's why the Koreas and Japans are so frustrated. But in terms of when he wants to throw this in the mix, sort of unclear, except I will say this president is feeling pretty good, coming off some impressive legislative wins and foreign policy wins. He may feel like right now is the time he has the bandwidth to put these forward.
So do you think he'll be more aggressive and let a lot of this drag on?
I think he is feeling bullish and more aggressive, and at the same time, the market, isn't necessarily always buying all of it. So that probably also tilts in the direction of wanting him to go even further. But again, of course, there's a lot of back and forth. I don't believe, for example, that Japan or Korea will end up ultimately with a 25% a reciprocal tariff. That's all part of the process. But directionally, again, we think we're on an upward move. And yeah, I do think he's feeling pretty good. And generally, that leads presidents to be a bit more bullish.
Sarah Bianchi of Evercore. Sarah, thank you. Certainly emboldened by all-time highs in the equity market more recently as well, perhaps. What do they say? Comparison is the thief of joy? It depends what you compare yourself to. And I think the market's comfortable with the idea that things will be worse maybe than the start of the year, but better than April 2nd. And so long as things are better than April 2nd, I think people can move on.
That was really deep. I love that. We just have to lower our expectations and then we'll be
Isn't
really
that what
happy.
we've done?
I mean, it's essentially the truth, though. We have to lower the expectations. Just don't make it that much worse, and then we're fine. I mean, 15%, the highest tariff rate since 1930s. It's okay. We can adapt and adjust, and that seems to be where the market's going.
Equities just off. Record highs on the S&P 500. Firmer this morning by 0.1%. Up next, the Daimler Truck North America CEO, John O'Leary, on the impact of tariffs on the industry. Plus, Yahara Anand with your morning movers. AMD shares rising on a price target hike from Citi, from New York. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Live from New York City this morning, good morning. Snapping a two-day winning streak on the S&P 500 in yesterday's session. We pulled back from all-time highs, the biggest one-day loss going back to mid-June. Your bounce is pretty mild this morning, up 0.1% on the S&P 500. On the NASDAQ, up by around about a quarter. With 2 hours until the opening bell. 2 hours away from your cash open with your morning movers. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. We have a few stocks moving off sell-side calls, and we start with AMD up about 1.5%. The chip maker rising after Citi raised their price target on the stock from $120 to $145. They are citing stronger than expected demand and signs that tariffs aren't hurting the chip industry. They say that across the board in the sector, they see solid demand driven by customers replenishing inventory. So good signs there. Next up, we have Bank of America. The Wall Street giant is falling 1.8% after HSBC downgraded it from a buy to a hold, citing limited upside ahead as these bank stocks have rallied nicely since their April low. We heard something similar last week from David George, who gave JP Morgan that rare downgrade due to the price. And this, of course, is coming as we kick off bank earnings next week. And we end with another financial stock, and that is Capital One. It is up about 0.9% after TD Cowen upgraded it to a buy, citing upside from the Discover deal, including being able to reach more customers globally. Plus, analysts there see the potential for major buybacks ahead. And as a result of all these tailwinds, they are also raising their price target to $258 on the stock. John?
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, our top story, President Donald Trump delivering a wave of tariff letters yesterday informing countries of their new tariff rate. At the same time, Trump signing an executive order delaying the increased duties until August 1st.
So 113 days now is basically going to be how they can get these deals done. It was 90 days. Basically, when you look at these rates, though, coming out of these letters, the rates are the same. The dates are different. The question, of course, is can they get this done, and how credible it is. Both of you have been bringing this up. How credible it is when the president's language is incredibly ambiguous and wishy-washy. Quote, I would say firm, but not 100% firm. If they call up and they say, we'd like to do something a different way, we're going to be open to that. But essentially, that's the way it is right now. So basically, everything is fluid and everything can change.
I didn't get a letter. Or do you think that there are trading partners that are kind of offended? You know, you didn't single me out. Well, I just wonder what we're going to end up seeing in terms of actual deals. If you didn't get a letter, does that mean that you get, a ticket to the prom?
Well, I think Bosnia and Herzegovina was potentially annoyed. There was a correction that had to be released in the letter because the president said Mr. President, but it was Madam President. So there were some individuals who got the letter and said, actually, I think this was directed at potentially the wrong leader of the country. And there was a correction yesterday
There's
as well.
some signal in that. This has been rushed. They need the extra time. A lot of people thought they'd need the extra time back on April 2nd and back after a week later when they announced the 90-day delay, and here we are. They need an extra 3 weeks.
Which, again, goes to the question of, are they losing leverage? And do they lose leverage by not just saying, look, this is a complicated procedure, we're going to have to kick the deadline, versus just say, you know, we've got letters, and this is going to be a serious negotiation because the market's not taking it very seriously.
It's some serious tension. You can see it in the economic data, at least. German exports sinking more than expected for the month of May. The value of shipments to the US plunging to the lowest level in over 3 years off the back of these tariff threats.
Yeah, so this is a real question about how much the European economy is going to suffer under the weight of some of these tariffs. We've been talking about European exceptionalism, about how there's this sort of renaissance in European equities, and this kind of challenges that a little bit, this idea that maybe they could take a hit. And frankly, this goes to the question of how much more can the euro strengthen on the heels of potential tariffs that could weaken the U.S. economy if we haven't accounted for the weakness in Europe on the heels of some of these levies.
Last week was fascinating. We had pushback from ECB officials. Off the back of the euro strength, and the euro stared it down and moved on and keeps grinding higher. I find that really interesting. The ECB's verbal intervention, and I think we can call it that, of the past week, has barely made a dent in the rally of the past several months.
They weren't scared by some of the ECB officials saying getting above 120 versus the dollar would make it complicated, and the market said, okay, make it complicated.
Let's keep it on Europe. President Trump saying he'll ship more weapons to Ukraine following talks with the President Volodymyr Zelensky last week. The move marking a reversal after the Pentagon halted flows of some weapons to the country in the past few months.
And the DoD followed up after the president's comments yesterday with a statement last night saying, at the direction of the president, they're going to be sending additional defense weapons to Ukraine to ensure Ukrainians can defend themselves while they work to secure a lasting peace. The president's rhetoric is starting to get a lot hotter when it comes to Vladimir Putin than it is to President Zelensky. President Zelensky has talked about that their most recent phone call was the best one they've had since. And when it comes to Putin, Trump has said, I'm disappointed, frankly, that he hasn't stopped and he's not happy about it. And now he's sending weapons to Kyiv.
That's the latest on foreign policy. Here's the latest on trucking and the truck industry. Daimler Truck kicking off its Capital Market Day event today after lowering its sales and profit guidance for the year back in May, citing economic uncertainty in North America due to, guess what, drum roll, trade tensions. Daimler Truck North America CEO John O'Leary joins us now for more, alongside Bloomberg's Matt Miller. John, first of all, to you, sir, there was that downgrade to guidance back in May. I understand you've got an update for us this morning. How have sales been trending ever since?
Yeah, first off, thanks for the honor of being on your show. Yeah, I mean, it's definitely a lot of uncertainty out there right now, a lot of people waiting for the dust to settle. I think people are just looking for certainty, whether it's tariffs or any other economic policy. Our customers are kind of in wait-and-see mode because their end customers who generate freight moves and ultimately freight rates are also in wait-and-see mode. So everybody's just kind of on the sidelines, you know, waiting for some sign of certainty.
And not buying trucks, it looks like you had a drop of 20% in unit sales in the second quarter. Is that, you think, likely to pick up now that we've got this big, beautiful bill and we're starting to see trade deals go out? Or do you expect continued uncertainty to hold back revenue in Q3?
Well, I think there's a lot of interpretation of the big, beautiful bill that needs to happen. And ultimately, like I said, end users who generate freight, they need to figure out if it's good for them in their particular industry. Obviously, our customers are hauling everything from steel to groceries to petroleum to everything. So how the bill impacts each one of those end markets ultimately drives, you know, a segment of our orders. So we'll have to see how that all shakes out. Still, I would say a lot to remaining to be seen, and it's all not just the big beautiful bill. Also, there's economic policy, and you've been talking about tariffs and other things out there. So there really needs to be, I think, a firming up of economic policy before people understand or realize this is what we have to work forward with, and then we can all adjust and move. But in the meantime, there's the uncertainty just has people frozen.
You have, I don't think a lot of people realize, I think you make more school buses than anybody else in this country. You have a ton of production, obviously, in the United States of America, but also a couple of plants in Mexico. How agile is your supply chain? How easily can you move, you know, Freightliner production back to U.S. plants, or up the count of U.S.-made parts in your Mexican-produced trucks?
Yeah, that's a great observation. And yeah, we are the nation's largest school bus producer as well. Thomas Built School Buses, which is located about 30 minutes east of where I am right now. We have a number of plants in the U.S. This Cleveland truck plant is our largest heavy-duty truck plant. About an hour north of Charlotte, we have another medium-duty truck plant just west of the Charlotte airport. We've got a parts plant in Gastonia, also by the airport. We've got a custom chassis division located down in Gaffney, South Carolina, just over the border. So we're hugely located center gravity-wise in the Carolinas. But then, as you said, we also have a couple of plants in Mexico. So we're flexible. We can build any of our models in either country. You know, we've really tried to, let's say, be as flexible as possible. And certainly if we ever got into a peak market, you know, we might have to look at expanding some capacity in the U.S. to be able to accommodate that. But certainly today at the market levels we're at, to move it back and forth is really not so problematic. You also alluded to the supply chain, and that's probably the bigger issue because, you know, a lot of those folks, it's been well documented, the integrated nature of automotive, and we are obviously not cars, but we're part of the automotive industry writ large. There's a huge amount of integration between Canada, Mexico, U.S. in the supply chain, and that takes a lot longer to be able to, you know, to adapt. There's just not too many empty plants sitting around in the U.S. That are currently, you know, up to date with tooling and a workforce, you know, parked outside waiting to go to work. All that stuff takes time. And typically to bring a new plant online or even to refurbish an old one and get it up to today's standards, you're talking 3 years potentially. So it's not an easy problem to solve.
John, in terms of the tariff that gets slapped on your trucks assembled in Mexico that come back here for sale in the U.S. market, the 25% only applies to the non-U.S. produced parts, right? So if you have a truck that's made of 40% non-U.S. sourced parts, that's only like a 10% hit. How much of that can you eat? Because you have pretty fat margins, right? 14, 15% in the trucks business. How much of that tariff can you eat, and how much do you have to pass on in price increases to your customers?
Yeah, so today, obviously, we're USMCA compliant, you know, under the existing regulations, and obviously there was some discussion still underway by the administration to reopen USMCA. Today, that requires roughly 65% U.S. content, which for our Mexican trucks, we're able to definitely, let's say, bring into line with the powertrain, whether it's engine, transmissions, axles that we ship into Mexico for installation, then ultimately get credited back when they come across the border for some inside baseball. But yeah, you're correct. I mean, there's definitely some inflationary pressure that comes with any kind of tariff. And what that ultimately shakes out to is going to be the nature of what the tariff is. So there's also a competitive landscape to consider as well. Obviously, I think every manufacturer would love to push every dollar of tariff out as fully into the economy as possible, but you've got competitive pressures as well, and we're in a pretty competitive industry. We have some great competitors that we fight tooth and nail with. So how much ability we have to ultimately do that remains to be seen.
I want to come full circle because this really does bring us back to the answer to John's initial question. When you said we're ultimately in wait and see mode, we've been trying to quantify what that uncertainty looks like for someone in the C-suite like yourself. What does that mean? Does that mean you're not making certain investments, that you're not making certain hires? Is that the reason why you're buying back stock rather than necessarily investing, say, in autonomous driving capabilities?
So, I mean, we've always felt since we became a separate company in 2021, we've been very bullish on stock buybacks, and we've continued to do that. So that's not a new thing, a new decision that we've made, you know, in reaction to anything else that's going on. That's an independent decision, and we clearly want to make sure that even as we do that, we have other money to pay dividends with and other money to make investments with. So we've obviously thought that through, and we feel like we're fine in any situation there. But yeah, in terms of investments, those typically are more driven by environmental regulations. And there's a lot of change going on there. We haven't talked about that, but there's clearly a lot of change going on. Obviously, the EPA has rolled some things back. California has rolled some things back. And ultimately, that drives a lot of our major investments, because when you talk about bringing engine or ultimately the entire powertrain up to speed in terms of more fuel efficient or lower CO2 or whatever the regulations are, there's a big cost that's associated with that.
Hey, John, I know you've got a busy morning. Thanks for making time for us. Appreciate it. John O'Leary there, the Daimler Truck North America CEO. Thank you, sir. Matt Miller, thank you.
My pleasure.
It's good to see you.
It's great to be here.
Thanks for dropping by and waking up early. Thank you very much.
I mean, normally I'm sitting in the control room watching your show.
For the benefit of the audience, you keep going with that. Matt, appreciate it. Look out for Matt Miller again at 9 a.m. Eastern Time as we work our way towards the opening bell. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Here's Lizzie Burden. Hey, Lizzie.
Hey, John. President Trump says that he's going to travel to Texas on Friday to see the devastation from flash floods, which killed at least 100 people and left dozens still missing. The deaths include at least 27 children and staff from a summer camp. Recovery teams expect to find more victims as a search continues. And elsewhere, Porsche shares are higher after the car maker reported a slowing decline in first half sales. Deliveries came in at 6% lower in the first half from a year ago, with fierce competition in China leading to a 28% sales slump in the country. Growth in North America slowed to 10% after an initial 37% surge in the first 3 months of the year. And in sports, the Wimbledon quarterfinals get underway this morning with Taylor Fritz and Carlos Alcaraz both set to play. Top-ranked Yannick Sinner will play tomorrow after surviving an upset scare against Grigor Dimitrov, who had to retire due to injury during a 2-set lead. In the women's tournament, number 1 ranked Arina Sabalenka will play centre court later this morning. And that's the Bloomberg Brief. John.
Lizzie, thank you. Heartbreaking for Dimitrov yesterday. Just brutal to see him 2 sets up against the world number 1 and then have to retire. Matt, before you go, just one final word. The 911. What happened?
Yeah, we saw a huge dip in 911 sales in the first half, so Porsche broke out sales globally. But here in the U.S., they sold a lot more Macans, the lowest priced vehicle that they make, and a lot fewer, like 1,000 fewer 911s.
What's that telling you?
It means that the prices have risen so much that U.S. consumers are really starting to pull back.
Where's your 911?
I've been in that 911.
I went in that too.
I love that car.
It's a nice car back in the day.
It's a very well-made car. It's over-engineered, which is why people love it. But it's really expensive, and the price continues to rise higher and higher, obviously, with this tariff.
Who's got your old 911 now? Where is that?
It's in Berlin.
It's in Berlin?
Yeah, yeah.
Okay. So
doing the speeds it deserves.
The happy owner of Matt's old car. I hope you're enjoying that, Matt. Thanks again. Up next on the program, Crossing a Line.
This is a time now for Musk. He needs to choose. I think there's a line in the sand that he's now starting to cross. I believe you've now hit a point. I think the board's going to have to get involved.
We'll ask that question to the ARK Invest CEO, Kathy Wood, who joins us next. Live from New York, this is Bloomberg.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of 2 million to 8 million. So we truly believe that we will get a return on investment. And it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince.
Concerned that none of the guardrails may be set up just yet.
Headline after headline. Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
Stocks are positive here by 0.1% on the S&P, up by 0.3 on the Nasdaq 100. Under surveillance this morning, crossing a line